Good afternoon, fools, and welcome to another episode here of Fool24. We are now live on YouTube for selected hours, and for our members watching us on the Fool platform, we have already been doing a few hours here of Fool24. For those on YouTube, Fool24, we do have kind of a great Q&A session, joined by usually two co-hosts. Today, I am Jose Najarro. Well, I'm always Jose Najarro, but in today's episode, you're going to have me, Jose Najarro. I do focus on the semiconductor space, and we do have Neil, who also focuses on the semiconductor, tech, and fintech space. So good afternoon, Neil. How's it going?
Good afternoon. Today's Jose. I am Neil for today. We're doing good.
Yeah, we were just coming in from a great hour, Neil, right? I mean, we went over the hour. It went a little bit longer than expected. But for those watching us on YouTube, if you want to get any questions, go to slido.com and put the code Fool24. There you can kind of get questions in. And again, what Neil and I are both contributors to the Motley Fool. We are not providing any personalized advice. We're just kind of sharing our thoughts and maybe how we manage our portfolios at the moment. So yeah, Neil, I think there were a few questions that we were talking in the last episode. And in the last episode, Neil, one thing that really caught my attention is an S&P 500 ETF versus an equal weighted S&P 500. And I pulled up, I'm going to present some charts here to kind of see how they have performed. And it seems like there are a variety of 500 equal weighted ETFs. The one that I found was from Invesco, and the ticker is RSP. And if we look in the past 10-year time frame, it's done 159. And for those watching, full total returns includes already expense ratios from an ETF. It also includes dividends that you might have received. So it's the whole story. The SPY, Neil, has done 236%. So we can see the SPY has done a lot better. In the 5 years, it's a lot closer. 116 versus 90%. But again, the S&P 500, how it is, has done better. In the past 3 years, I want to say, in the past 3 years, obviously, we've kind of seen this big boom in the Max 7. So I think you would have expected more of the SPY to be doing better. But we can see it's almost probably about an 80% B or going higher there. Then in the past year or so, a little bit closer. Both doing kind of in the teens. And year to date though, Neil, it is the other way around. The year to date, it does seem like the equal weight portfolio is doing a little bit better. So yeah, that's pretty interesting. For some reason, I thought there would have been a little bit closer in the long term, Neil. I did expect in the short term for maybe the S&P 500 to be doing a lot better, just because it definitely has been kind of a Max 7 stock driven market. But I thought when we would have seen that 10-year gap, it would have been a lot closer than expected.
That's interesting. I mean, it's true that we have rebalancing every now and then. So at least there is that. But yeah, that's quite interesting to see those side to side. Very interesting.
Let's see, Neil, any questions here we have from the last hour still? Oh, wait, I actually have one from Ed, Neil. Do you own Bitcoin? If not, when and if would you start to buy? Does Bitcoin price movement follow the markets in general, or is it a hedge? So about three questions there from Ed, Neil. Any thoughts here on the crypto space?
Question number one, do I own Bitcoin at the moment? Other than the $15 that Robinhood gifted me for opening an account? No. I did back from 2017 all the way to 2021. I had crypto, but today not anymore. Why? Just doesn't make sense to me anymore. It did before, doesn't make sense for me right now. Does the Bitcoin price movement follow the markets in general, or is it a hedge? I mean, if you look at the long-term returns for Bitcoin, of course, it's probably the best asset out there, right? If you manage to buy 10, 15 years ago, of course, you're beating the market and then some, despite the ups and downs. But more recently, as it became more and more popular, I have a feeling that when we have a bear market or when there is bearish news, macro, whatever, everything goes down, Bitcoin included, which shouldn't have been the case, right? Usually, I mean, the maxis will tell you, oh, you buy Bitcoin because you don't want to be dependable on what's going on in the real economy or macro. Like if we have a recession, Bitcoin usually should be doing better. But what we are seeing right now is that's not the case at all. Like the market goes down, Bitcoin goes down. Now, from a keeping the value of, let's say, that currency, because from the start, this was supposed to be the currency of the internet, should tackle inflation and all of that. True that over the long run, I mean, if you held the dollar or you held a Bitcoin, holding a Bitcoin makes way more sense. Just that today I see it more, of course, not just today, but for a while now, it's not really going to be a currency because it's expensive and slow compared to all the other alternatives that are out there. It's another trading asset, I would say.
Yeah, Neil, I'm going to say this is one thing that I don't really follow much. So when I was younger, I did own some. And it's just like, hey, look, I felt like maybe I needed to expose into other segments. I don't own any anymore. And not for any bullish or bearish reasons. It's just not a market I feel like I need to invest in. I think the market, and this is the great thing about the market, right, Neil? There's so many opportunities. You don't have to be in every single opportunity. When one train leaves, another train eventually comes back that you can take to whatever type of growth you want. And again, I don't think I'm smart enough to determine if this is much of a hedge, but I do believe now with the popularity of investing in general and social platforms, it moves a little bit more on just reactions to random things. So the price movement has become a little bit more volatile, and I wonder if it's just more retail investors just during a really good market, everybody has a lot more money to spend, so they're willing to buy Bitcoin. During a bear market, people are a lot more careful with what they end up using money for, so you tend to see less volume on Bitcoin, which reacts to the overall price. So yeah, I don't know. I think during now it's going to follow very much the cyclicality of whatever main market is happening right now.
You know, and I agree, like the first statement that you made, like you don't have to own it. Just like you don't have to own this stock or that stock. It's just another thing that you might want or might not want to own. Like people buy paintings, Pokemon cards, sneakers, whatever. Like I'm not saying that you have to own a first edition Charizard in a PSA 10. No, if you want to. A first edition, I don't. I have a base, but a first edition, I don't. So yeah, with Bitcoin, I can see the appeal. But if I wanted exposure to the whole crypto market, I'd probably go with players like Robinhood or Coinbase that make money on those transactions, on those trading fees. But I wouldn't want to pick one particular coin. Although yes, Bitcoin is the big one, is the number one. But yeah, right now, younger me, yes, did hold it, was fine. Today, just lost interest, I'd say.
Thanks for that, Neil. So Neil, there's a question that it was about 2 hours ago from Kent, and it seems like he came back and we never answered the question. So I want to do this one for Kent. So Kent, about 5 minutes ago and about 2 hours ago, your thoughts on entry point on AMD now or wait for support. So Neil, when you kind of, how much is technicals in your buying process for a company that's kind of like AMD? Like for AMD, are you looking more at the business side? Are you looking more of the technical? I sometimes feel, Neil, that valuation metrics, like for me, a PE ratio, can kind of give me a best of both worlds, where a lower PE ratio might actually be a little bit closer to maybe some of the support technicals out there. So I feel like sometimes metrics can help me be that middleman between the business, valuation, and maybe some technicals.
Yeah, I mean, with AMD specifically, it's been a funny one because I mean we've been making video articles, so we get to see the comments, and it's always, oh, don't try to catch a falling knife. I mean, okay, that is true. Catching falling knives, especially if it's just starting to fall, you might get hurt. But more recently, I just look at the value that I'm getting. I mean, I know a week ago it was at $110, and now it's at $100 or $99. Okay, it's down a little bit. But if I say that the value that I'm getting at $110 per share for the business that we have today, plus the projected one for the next couple of quarters, is good enough for me, I don't mind that, oh, I'm catching a 49 because it's under the 200-day moving average or another moving average or whatnot. If I see that the business is doing well, the value that I'm getting today is already quite good for me, then I'd probably just focus on that. Because if you look at pricing metrics like the 4 PEs, all of that, those can change. First of all, those can change because if suddenly the average analyst earnings per share prediction goes up, then suddenly your forward PE is coming down. So I rather just look at the company. It's true that when things are extremely overvalued, then yes, if you are looking at the chart and it doesn't look that pretty, fine. Then you're not paying a good price for the value that you're getting. But with AMD, I mean, $110, does it really make that much sense to me if I believe that in the future this becomes a much, much bigger company? I don't think that $10 difference, that 10% difference is going to make much of a difference in the long run. Plus, if I like the value at 110, I should love the value at 100, and I should love it even more if it goes under that.
Agreed. So, I think a perfect way is, at least when stocks are dropping, it's going to be almost impossible for you to catch that bottom. And it's also funny, right? I feel like when I hear the term falling or catching a falling knife, I think about it for companies that I would really only use that phrase for a company that might be seeing weakness in the business and also kind of moving with the stock price. But I feel like AMD is not seeing real weakness in its business. I mean, it's growing in the CPU space. It's growing. The embedded market is picking back up. It's expected to have hit its bottom. It's same with its gaming market. And eventually there's going to be a new cycle of consoles that can drive that segment a little bit better. The server CPU space is still pretty good. And while maybe the GPU market is not a $100 billion business like it is for other companies, it went from 0 to 5 in no time, in a year. Which is very, very impressive. So I see this as a company that has been showing that they're moving in the right direction, but the stock price isn't. And a market cap of 162 billion, I feel like if this moves in the right direction, if it continues to move in the right direction, I think in the next 5 years, this could be a $500 billion industry. So for me, I'm saying I can potentially maybe 2 to 3x in 5 years, my investment. I'm liking it being 110, like you mentioned, being 100, with the mindset that I know if I buy now, the stock can continue to go lower tomorrow. Tomorrow it could be 95, or next week. But in the long term, I believe it's going to be much higher than it is right now.
Yeah, and I think when we get the comments of, oh, don't try and catch the falling knife, try and catch the rebound, wait for a rebound and stuff like that. I think for long-term investors, it doesn't really matter. For day-to-day traders, of course, it matters because you're looking for that small percentage gains each and every day, maybe each and every hour. But yeah, I mean, I don't, with good companies like that, I don't mind sometimes for it to go lower, because that just means that I can buy more shares of a good company for cheaper. Of course, that only works if you have a cash position that's big enough for you to take advantage of these types of dips or crashes, however you want to call it. So I can understand the argument that if you don't have any cash, then okay, then if you buy it, let's say 150 and now it's at 100, you feel like you've made a mistake. So I can sometimes understand that argument, but that's why it's important to me to have cash on the side always.
Thank you for that, Neil. Neil, I'm going to take this question here that came in about 30 minutes ago from Sarang. Thoughts on ASML, Lam Research, and Applied Material in terms of the next 3 to 5 years outlook. So, Neil, I think in the next 3 to 5 years, all three companies here are going to be bigger than they are today. So that's going to be my first in kind of just the top level overlook. The reason being is we have kind of seen a very weak stock markets and just a very weak business for the equipment players, as there hasn't really been a growth of equipment sales. But one thing that we heard from TSMC most recently, Neil, is that they're increasing their capital expenditure dramatically this year because they're seeing a growth in a lot of different markets, not just AI, but consumer space as well. And that's going to drive various equipment sales growth. So I think all those three players, Neil, can benefit strongly. So I think the next from now to the next 5 years is going to be great for equipment players, especially as we are seeing kind of manufacturing plants being built all over the world. And we're also kind of going to new forms of chip manufacturing below 2 nanometers that's creating the demand for more solutions. We're also seeing the memory market innovate, which is thanks to things like HBM, which is driving the needs of more equipment tools. Now, Neil, if I was to kind of put which one I think will outperform the others, I think in ranking, Lam Research, Applied Material, and ASML. ASML would be last, Neil, because I think ASML's, their equipment, while it's a monopoly, it's very limited to how much they need of this equipment. So while there will be a growth rate in it, I think the growth rate difference is going to be stronger on those other players. We've heard from Lam Research. I think we did a Lam Research presentation yesterday, and Lam Research really believes that they can outperform the wafer fabrication equipment spending. And I think that's the case because it's going to be driven by memory. So while the whole market is going to be growing, I think Lam Research will be growing a lot faster than the rest because of that memory space. I think Applied Materials also, they do focus a lot on advanced packaging solutions, so they can also grow up faster than the market. I think ASML, Neil, it's going to grow with the market. I don't think it's going to grow faster than the market. And that's still bullish. I still believe that ASML can still be a bigger company than it is right now. But I think in growth opportunities, the other players have a little bit more optionality. Any thoughts on those three, Neil?
I think with ASML, I think we'll have to wait until their next big product comes out, which is going to be even more expensive. But then when we reach that point, we are going to have to see if the likes of Samsung, Intel, TSM are willing to spend that much. Because I think right now they're all making sure that they're going to utilize the existing ones until they really don't need it anymore. And then only order the newer machines, which again are expected to be more expensive than what they're buying today. But in the meantime, they also have that yearly management fee that they're collecting. But in the meantime, I think last quarter has shown us that free cash flow wise, pretty good business. Especially last quarter, we've seen a nice rebound. And I do expect that to continue. So looking at free cash flow growth, I think free cash flow outpaces the current expectations. ASML is still a very, very good business all in all. But yeah, I agree that a player like Lam Research, for example, especially at today's prices, would probably outperform.
Yeah, and I just want to double check, reiterate, I'm not saying I'm bearish on ASML. I think all these companies will be bigger than they're at right now. But if I had to, I think ASML is more like that safer play. And the reason it's safer is it might not grow as fast, but I think the returns are going to be there. And like you mentioned, all these three companies, they'll have kind of that service maintenance. So the great thing is they've all been able to kind of maintain strong free cash flow during this downturn. As they sell more products and have more more customers, that's only going to continue to increase and be a nice driving force for their revenue and free cash flow in the future. But yeah, so that was a pretty good question, Neil. Do you have one you want to tackle next? I see Ed might be asking one about 60 minutes ago about a fintech play. So I don't know if you want to jump into it.
Yeah, I can do that. And then we can do Sadaf's question from 24 minutes ago. Your top 5 semi stocks. So I'll give you a couple of minutes to think about that. So Ed asks, SoFi, will this company be a game changer in the marketplace or just another company taking care of customer needs? So with SoFi, what we're getting right now is, of course, a small fintech players that wants to be a top 10 financial institution in the United States. Now, SoFi is, of course, offers lending services, financial services, and the tech platform, which is Galileo, which is a company that they acquired a couple of years ago, which, by the way, is used by the likes of, I believe, Chime and Robinhood and these types of neobanks / trading platforms. That segment has not grown as fast as previously expected, which, I mean, is not fully their fault. There is some winter market happening in that industry, but they do expect that to reaccelerate towards the end of 25, going into 2026. Last quarter, they already told us that a couple of contracts will come into effect in 2026. But the other segments, the lending segments, the financial services one, are growing quite quickly. Financial services is actually growing extremely fast, and the lending segment has started to reaccelerate more recently. Is this going to be yet another fintech company? I don't think so. I think they are doing things that traditional banks have not been doing for a long time, because it has a bank. That's the thing. SoFi isn't a bank, it has a bank, and it can also operate like the modern day fintech companies. Although currently it doesn't offer crypto services anymore, because once they got that bank charter, they were not allowed to offer those services. But with the new administration coming in, some changes might be made here. So we'll see. I think that if they can reach top 20, top 10 financial institution in the United States, I think it's not only going to be quite positive for the customers, because you're going to get, well, a way better service than what you're getting with the traditional players, but this company could start to change, let's say, the financial industry only in the United States, right? With players like Nu, for example, and yeah, maybe even Robinhood. You can have some international play as well, but SoFi is just right now fixated on the United States. I like the company. I like the management. The size of the company right now also makes sense from a risk-reward standpoint. I think it can grow to become much, much bigger. Plus, that technology platform does give you a hedge, let's say, because if traditional banks do want to modernize, they'll probably go to a Galileo, which is basically owned by SoFi, to modernize their whole system. So if a traditional bank starts to make some waves, becomes more modern, SoFi is winning as well, despite it being a competitor. So all in all, that's a quick SoFi story.
Thank you for that, Neil. I don't have anything to share there, but I did take the time to kind of think of maybe some of my top 5 semi stocks from Sadaf. So 28 minutes ago, your top 5 semi. Neil, I'm also going to give you time to maybe think now of some. So Neil, when I was thinking about this question, I was thinking of what if I can only own 5 semiconductor stocks in my portfolio, and it would be a 5-stock portfolio, what would I do? So first, I would try to kind of diversify into different industries. The first one is the AI beast. So for my first stock, to no shocker, is going to be NVIDIA. The second one, Neil, is going to be one that I consider kind of the best around player. It has its foot in a lot of different markets and is sitting at a great valuation. For that reason, I think I will choose AMD for that one. So this is kind of my best overall rounded play. Then I wanted to focus on one in the equipment space. I think the equipment market is going to be one that we're seeing wafer fabrication equipment spending increase. We kind of talked a lot about kind of the growth opportunities with new manufacturing, new advancements in memory, new advancements in how chips are being made. So I wanted an equipment player. I do believe this one's going to grow faster than the wafer fabrication equipment, like they mentioned, especially due to the memory market being so strong right now, or potentially being stronger with things like AI consumer tech. So Lam Research would be my third pick. Now, the next pick, Neil, I wanted one in a segment that was pretty weak, that one that I believe the market doesn't like right now, but so the stock price is trading at cheap levels and is able to be really good when that market turns around. And I think right now the automotive market, Neil, is completely weak. I mean, we've seen demand kind of gone down, and it's been like that for a while. And I don't know when things are going to pick back up. But when it does pick back up, I think we're going to see growth in innovations in chips that are used on not just traditional cars, but EV cars. And then the same type of car chips can be eventually used in things like robotics, and power chips are also being used in things like AI servers. So on semiconductor would be my fourth one, Neil, where this is a stock I don't know when it will turn around, but management has showcased that it can handle a cycle. Unfortunately, one of the ways is reducing kind of the employee count right now, and that's what I think they just did a few days ago. But last quarter, they were positive in free cash flow, Neil, and that's what you want to see during a very weak market. So on semi would be the one that would bring me into the automotive space, and the space not too popular. The final one, Neil, I would go with the small cap. A small cap company where I believe they can grow. And this small cap I would pick is Air Test System. So it has, for me, various growth opportunities. First, it has the growth opportunities in equipment. So that would be the first thing. Just overall equipment spending is going to increase. Air Test System can benefit from that. For those that are not familiar, Air Test System does like a stress test, Neil. If you own a wafer, if you want to test your wafer, you kind of put it in their machines, high voltages goes through it to make sure that the chips are good. So it's like a stress test. Right now, their main market is EVs. So obviously they're very weak right now with the EV space, but they've recently kind of made acquisitions and have increased their portfolio to do testing like this on AI accelerators. So they can definitely benefit from AI accelerators. And they also have these testings that are used on things like optical IO, which is great again for AI accelerators and other types of communication. So Air Test System would be my massive growth opportunity play, my high risk to reward ratio. So if I can only pick 5 stocks, I think those would be the 5 on my list as of today. Could change tomorrow.
Interesting. I think I'll just go with the classic ones. I'll probably put TSMC on that list. I'll say TSMC, in no particular order, just TSMC, ASML. If I only had to pick like 5 and never touch them again, so it's TSMC, ASML, Micron, because I want exposure to that memory space, and then I'll have to sacrifice one of the 3, because I want to push Intel into that top 5 because I believe in Intel, but only if it stays Intel the full company. Like if they sell off the foundry side or whatnot, then it get kicked out of the top 5. Then I have to put AMD and NVIDIA in there. So this is the top 5 and a half.
I think that's a solid list, a very solid list for sure, Neil.
Yeah, I think you cannot go wrong with those 2 lists here.
Neil, there's 2 questions that came in recently. We haven't answered one from Jim Bob SquarePants. So let's take that one maybe 19 minutes ago. I have a nuclear pie from a fellow trader. This includes companies like Rolls-Royce due to the endeavors in future using nuclear. Neil, do you own any nuclear energy stocks? If not, why?
First of all, great name. Second of all, I do not own any nuclear names in the portfolio right now. Why? Simple answer. I have no interest in owning nuclear names in my portfolio at the moment, although I can see the appeal. Just right now, it doesn't fit the teams or the needs of the portfolio. How about you?
Neo, I don't own it. And the main reason I don't own it, Neo, is because I feel sometimes investors look for stocks that are in different segments to try to diversify, right? To try to get diversification. I think right now, Neo, nuclear stocks are what I call false diversification if your reason for buying them is to diversify. And right now, I mean, we saw from the whole DeepSeek movement that nuclear stocks move with the same momentum as AI stocks, because at the end of the day, right now, the main demand for these nuclear energies and the main popularity, or why these nuclear stocks have been popular, is because massive data center companies need some form of new power solution. So if you're looking to diversify outside of the AI space, I don't think nuclear stocks is the best way. And I already have a very heavily weighted AI portfolio. I don't want to add more exposure to it because let's say you hear all of data center spending is actually going to slow down. That's going to be bad for my NVIDIA position. And if I had nuclear stocks, it would be bad for my nuclear stocks as well. So I'm limiting my exposure for that reason. And it's, yeah, I think that's one of the main reasons they just kind of move too much with my AI stocks, that I don't want to take the time to do more research on a segment that would just increase my exposure in it. But I definitely see kind of the growth opportunities. Maybe if you didn't have a strong AI portfolio and you kind of want to maybe invest in it without having an NVIDIA or some of these other AI plays, I can definitely see why nuclear stocks are getting some traction.
Yeah, and it does mention Rolls-Royce there. And I think Rolls-Royce is a good play, not just for, I mean, I think they're going to build small modular reactors, I believe. They're also in the aerospace. They make the huge engine. They're in the defense space as well. So with a player like that gets you also exposure in that nuclear team, I think it would make more sense than just picking one specific company that only does, let's say, SMRs or stuff like that. Because like you said, you are going to follow a specific team.
And Jimbo also mentions, yeah, this is excellent. That's fair enough. This is very long term, of course. Yeah. So definitely, I mean, I think eventually, Neil, every time some form of innovation happens in technology, you are gonna need some form. We might end up being power capacity constrained. So I think there is a future for nuclear power. And at the moment, I think it's really just in the AI space, but who knows in 3, 4, 5 years from now, if that bullish sentiment for nuclear enters some other avenue instead.
Yeah, for sure. I agree. I'm just looking at the Rolls-Royce price stock. It's has done quite well in the last 2 years, almost up 10x. So not bad at all.
Neil, I don't know if you want, a lot of great questions again. Alex had one on Shopify. I'm not really, I don't follow Shopify, so maybe because of that, I don't really understand the question too much. Do you follow it, Neil? And can you tackle that one or no?
I do follow, but I can't seem to understand the question. Like, when I look at Shopify earnings, I back out unrealized gains or losses on equity investments. Any thought on this idea? I mean, I think most of the companies do this, right? If there is a positive impact on one of their investments, like for example, an Amazon with Rivian or an Uber with some other investments as well, I think they show us and they tell us what that impact is, if it's a positive or a negative one. Yeah, if you want to look at just the core business, then of course it makes sense to like exclude the investments, because yeah, the investments have a positive impact on the company, but it does not necessarily show you how the core business is doing. So I would say, yeah, it makes sense. It makes sense.
I could be completely wrong, Neil, here, but I feel like nowadays, if you own something, you have to show the unrealized gains of it. Where back then you didn't really, if the stock price was down, obviously since you didn't sell, you didn't have to put it there. And I think that has created a lot of confusion now in some of these companies that might be investing a lot in certain segments or certain sectors. But again, as long as you're not, I want to say, as long as you're not a investment based company, I wouldn't really be too worried about it. I'll be more worried about kind of like the core business and how that's moving. Because we all perfectly know how a volatile market can impact our portfolios right now. And that's pretty much what would be happening to a Shopify if their portfolio was a little bit weaker compared to last quarter.
Yeah, no, that's definitely what we've seen with Shopify, especially also with Amazon, because of that Rivian investment. Took a huge hit, or then got a huge gain from that as well. But focus on the core businesses, especially with Shopify. It's quite easy. It's subscription and merchant solutions. You can see how that is performing. And of course, with Shopify, in my eyes, it's more of a free cash flow story, like free cash flow growth, than anything else.
And next question here, Neil, we got one 9 minutes ago from Kent. What are your favorite tariffs impact stock plays? I can tell you what's definitely not my favorite: semiconductor stocks right now. But Neil, are there any investments that you're looking at? Say, look, this is one that can benefit from more tariffs discussions or more volatility in this space. Quick answer for me: no, I don't. I don't think I know too much the tariff space for me to make a decision for a long-term investment on just that tariff thesis.
No, I agree. I don't have any place going on for the tariff trade or something like that. I think the only trade I'm doing is if good companies that I own are down because of those fears, I'll just pick up more shares of that. But maybe, I don't know, if you're looking at manufacturing plays, maybe steel companies, automotive companies and stuff like that. I do think I saw yesterday a chart that has shown a huge increase in imports in anticipation of the tariffs, which of course in the short run that might impact the GDP number because you're increasing that import number in just a short period of time. But it makes sense. I mean, of course you're going to import way more before the tariffs than after the tariffs. It's like before a shortage, you load up on eggs or you load up on toilet paper, and then you're like, oh, there's no toilet paper anymore. It's like, yeah, we know. But yeah,
You bought
so
them
far,
all.
I have chickens.
And Leo, I think this would be great. I mean, for other fools in Slido, if you have any ideas, feel free. I mean, I think the great thing here is, even if we might not have the answers, maybe some of the fools might want to share their thoughts. So if any of the fools have any thoughts on how you might be handling some of these tariff trades, let us know in the comments, and we'll probably share some of those thoughts throughout the episode. Neil, next question here. We got one from Vihan 7 minutes ago. Gentlemen, thoughts on Supermicro after earnings release on February 25th? Any takeaways from earnings? Neil, I feel like you follow this one a little bit closer, and so yeah, I'll send it to you first.
Yeah, so 25th was not the earnings, was the deadline for them to file the missing 10K and 10Q. Preliminary earnings report was, I think, a couple of weeks ago. But yeah, from that deadline day, which was February 25th, it was very interesting because we did talk a little bit about SMCI in previous shows. And to be honest, I was certain that once they reach that deadline and they file on time, the stock would go up because, well, they're not getting delisted anymore. But what we got is the exact opposite action from the stock. The stock is actually down 26% in the last 5 days. So it makes sense. It makes sense because the only thing that they did was file on time, a buzzer beater, I said, because it was literally like a couple of hours before it was too late. But in those filings, the issues that were identified were still there. So they noted that there were issues. They said that they are working on solving those issues, but those issues aren't solved just yet. And probably that's why the market isn't happy, because what have you been doing since August 2024? Like, we know you lost an auditor, you had to choose another one, which BDO, if you look at the list of auditors, is not really in the top 3. And then you had to deal with, I think, DOJ inquiry and stuff like that. So, okay, lots of things going on. But to me, it makes sense that the market isn't happy with the results. Plus, if we zoom out, stock is still up 36% year to date. So I guess that's the silver lining, that it's still up 36% year to date. Plus, you're not getting delisted.
Neil, did they do both? Did they release both their 10K and 10Q, or was it just one? Oh,
yeah, 10K and the 2 10Qs that were missing. Yeah.
Yeah, to be honest, Neil, I was kind of shocked. I was expecting more of a positive reaction. Now, outside of earnings, one thing that we did hear is this company did reduce their guidance. If we kind of look back at earnings, they did reduce their guidance for this fiscal year. And they did kind of provide a very strong guidance for next year. One of the main reasons that they did that, and they're about, I think, 2 quarters ahead compared to the calendar year. So they just reported either, I think, their second fiscal quarter for this year. So they mentioned one of the big reasons for this fiscal year being weaker was because they're not getting as many chips as they anticipated, and there was a delay in technology. Many are speculating, and I think these speculations are true. Many of that is delays with the Blackwell platform. That they were expecting to do a little bit more revenue here. Especially, Neil, one of the reasons they mentioned is since they're so strong in liquid cooling, because they would have been first to the market, that would have helped them drive more sales than not. But because of the delay, it probably helped its competitors finalize their liquid cooling solutions, where now it's like a equal playing ground. Now I don't know if I would consider that a moat, that if you can just do it, if you can do it a little bit faster for like 3 months, that's your reason for being maybe trading at a premium. I don't think it's trading at a premium, but yeah, it's interesting. It's also have been remarks that why are they not getting chips if NVIDIA is already sending some of the chips here to kind of like your HPE and your Dell technology. So there's a lot of discussions and a lot of uncertainty still with maybe some of the relationships with other semi players. I think this for me, Neil, is going to be more of a trading vehicle if I ever go into it. I don't think right now I will put this in an investment vehicle.
No, I agree. Plus, I mean, we've seen from NVIDIA that they delivered quite a lot of Blackwell in Q4 already. So can also start asking a question with SMCI, are they maybe losing some business from NVIDIA? And is NVIDIA looking at Dell and HPE for the other solutions? Which, I mean, we'll see. We'll see in the upcoming quarters, because if NVIDIA manages to post these strong Blackwell numbers, but ASML always comes out with the same explanation that, oh, there are some delays, we're still waiting for this and that, I don't think that's going to work for another couple of quarters.
And I guess, you know, this is why it's also very important to listen to various earnings calls, even if you don't own the company, right? Let's say you might own Supermicro. You might just hear, okay, yeah, it's just because of the Blackwell delays. But if you hear an earnings call from Dell and HPE and you don't hear those same type of remarks, that's where you need to start questioning things, right? So obviously the company management is always going to try to tell you that everything's perfect. But as an investor, earnings call, you usually only hear what you want management to tell you, or what management wants to tell you. So you have to sometimes take your time to listen to these other earnings calls to really see if what management is telling you is the truth.
No, agreed. I mean, that's why I like earnings calls, conferences with analysts, because you get to hear what management says, not what an analyst is trying to say, or what something else is going to, a news report or whatnot. Management tells us the story, and obviously it's up to you to believe it or not. But yeah, eventually the truth will come out, and it's really not in their favor to start telling us one story when the reality is another thing.
Neil, I don't know if you follow this market here. So Sarang, about 12 minutes ago, please share your thoughts on any promising AI players in the healthcare, medical device space. Any thoughts here, Neil? I do have two plays with very limited knowledge, but once I want to do a little bit more research on, if you don't have any.
Which one? RX?
Yeah. So for me, the two that I would pick first is Intuitive Surgical, ticker ISRG. Again, I don't follow these industries much, but from a top level view, the reason I want to do more research in here is I do believe the AI market is going to help grow the robotic space. Things like AI vision can help dramatically improve maybe the movements of robots. And I know ISRG or Intuitive already has kind of some of these robotic based surgery products. So they already have like markets there. And I'm going to guess most of these products already have some form of visions allocated to them. So that means they have plenty of data already. So with AI, that's a market that I feel can improve the core product, can make their robotics segment a lot stronger. So it would be I would want to learn a little bit more about that technology. How much is the robotics revenue for them? It's already a big company. I mean, it's $200 billion. So I don't have much research on it. So I have to see, is the robotics market really that crucial for this? But companies like that, where AI can improve the core product, and they already have kind of core products running around collecting data. The second one, I think it would be RXRX. This would be more of like a lottery play. A few things that they're doing is I've talked to someone, Brian. Brian, he is another full contributor here. He has a PhD in I forget in what subjects of material science. So he's definitely very knowledgeable in this space. And we kind of look at RXRX, and the type of medicines that they're working on are not in any phase that he would get excited about within the different phases of the medical realm. But one thing that gets me excited about that is they do have a lot of data. They have created a form of large language model that they can also kind of rent out and kind of have like some form of fees from it. And I think that industry is very new, and maybe a first player movement advantage can create some form of moat there right now. So RXRX is another one. That's one that I own, very small play. And it's one I just want to keep seeing evolve over time.
Yeah, no, I think Intuitive Surgical is a very, very interesting company. Their Da Vinci system, right? That robot with those needles thing. The install base continues to increase, so that's always good to see. It's a very interesting company. It's one of those companies that's on my watch list, along with Axon, for example, where if it becomes much cheaper, I know Axon did take a hit more recently. If it becomes even more cheaper, it's definitely getting higher on that watch list and may potentially be on the buy list for the future. But other than that, I don't think I can come up with some other names. I know there has been some hype around Tempus AI because I think Nancy Pelosi had call options on that. But yeah, Upsellarize is a small company. Basically helps other drug companies to find and develop new antibodies-based medicine. Once you reach a valuable solution, they can then partner up with other pharmaceutical companies. So right now at the price they're trading at, I think it's very, very close to cash, if not even better than that. But we know that the biotech space has been in a bear market for a while, unless, of course, you appear in a 13F of one of the big tech companies, and then your stock does go up.
Yeah, so when I think of like AI markets and companies in sectors that I wouldn't be familiar with, like here in the healthcare space, I would say there's two core businesses that can happen. Is one, the new products or new segments that are coming out of it, and those would be like those high speculative play, something like RX, or there could be a business where it is improving the core mechanics of it. And I think intuitive surgical could be one of those plays. And again, I am bullish in the robotics segment. So that's what got me a little bit more excited on this one. But like, let's say you are a healthcare company that maybe focuses on software solutions, or I don't know, something in software where you have a lot of data. Obviously, AI can help that core product a lot. So again, I'm not too familiar with this, but if any of the fools here can think of any healthcare that already has a lot of data and their core products can benefit, I think those are ones that can be strong AI plays in ways where you can see kind of improvements in revenue growth, improvements in maybe free cash flow, improvements in bottom line numbers, just because they're improving their core products and don't necessarily need to sell something new. They already have those customers. They can say, hey, look, we already do this, but we've added new features, so we're going to upcharge it. And we've seen it a lot in kind of these big tech players already, right, Neil?
Yeah, no, I agree. I think a couple of two other names that pop up is Teladoc, right? That was a very popular name back in the 2020, 2021 era. It's a good company, but as you see, good companies with bad management, that doesn't work out. And then maybe another one, I think one that popped up is Oscar Health. I haven't looked that much into it, but it's also one of those similar players. So definitely worth looking into that. Vian asks here quickly, Upsellera. It's ticker symbol ABCL. ABCL is the ticker symbol for Upsellera. I think we have time for maybe two quick questions here. So one here from Andrew from 13 minutes ago. Could you explain why they compare trailing 12 months GAAP PE with forward non-GAAP PE? Do you understand this one? I think he tries to say that when looking at trailing 12 months, we're looking at a GAAP PE, but looking at next 12 months, we're looking at non-GAAP PE, which of course gives it a growth narrative for AMD.
You know what, Neil? I've never really thought about that too much. I feel like when we use Y charts, though. No, now I'm curious. Yeah, I mean, obviously, you would want to do kind of those non-GAAP basis on both to get a better answer.
I mean, if you want, you can look at both. Like if we go on any of these websites, I think you can choose GAAP or non-GAAP. So
yeah,
it's up to you what you want to use. But of course, if you use trailing 12 months on a GAAP basis and a non-GAAP on a forward one, then yeah, it's a bit cheating. It's a bit cheating to make things look much better. But yeah, I think by default I've seen that for forward PE it's non-GAAP for some reason. So.
Well, I think the main reason is these non-GAAPs are kind of like eliminating a lot of these one-off expenses, and it'll be very hard for analysts to project a one-off expense that could be coming out of nowhere. So I think it's just the easiest way to eliminate a lot of variability that can happen in this segment, in the stock market in general.
Yeah. But then we should be looking at the same metric for the last 12 months for sure.
Definitely, you know, and maybe we can end with the final question. I think we're gonna sound like broken records here, Neo, if we answer Vihan's question. But gentlemen, would be nice to hear beaten down positions in your portfolio. If they're further down, you will be happy to add to your positions. Neil, I'll let you go first.
I mean, the answer is yes. the answer is yes. If I see my stocks in the portfolio that are beaten down for reasons that are non-business reasons, so macro related, then I see no reason why I shouldn't add more. Of course, there is a priority list probably. Those that are beaten down more, those that valuation is more attractive than others. So there is definitely a list in my head. But yeah, a downturn does not scare me out of, oh, stock is down 10, 20%. Maybe it can go down a little bit more. Maybe it can, maybe, I don't know. I don't have a crystal ball. If somebody has it, well, I would pay a lot of money to have a crystal ball. But if I see a downturn that is not because of business reasons of the companies that I own, I will be adding more to my existing positions for sure.
And Neil, any two that, let's say top two, I mean, you just mentioned in general, right? It's all based on as long as the thesis is intact. And very similar, Neil, I think for me, it's as long as the thesis is not broken. And as long as also, I think if it hasn't reached my portfolio allocational max, right? I don't want to just keep throwing money. If I'm like, okay, look, even though I believe it, I don't want to eliminate that risk of over investing because maybe I still believe there's some risk in the stock, even though my thesis is on tag. I understand I could be wrong, no matter how strong our thesis looks. Something can always go wrong. So I think as long as I would add that extra caveat, as long as the portfolio allocation still looks good, yes, I'll be happy to add.
I agree. I mean, when we have, let's say, a number one or number two position, not move that much, we are still bullish on that, but maybe for us it makes more sense to add to the number 5 or the number 6, obviously depending on the allocation strategy of each and every investor.
Yeah. So Neil, I think that is the end of our hour. And to all the fools, stay tuned. There's a lot of great products or episodes coming in. The next episode is going to be a replay on valuation, I believe, so stay tuned. But we definitely do have a nice amount of live episodes coming throughout the day. So for all the fools, thank you so much, and see you all next time.
Bye-bye.
Well, we will be doing a small transition, Neil, in a bit.
Right, as ProShop said, it is contractually obligational. We said Brookfield, and Jason and that hair appeared. Fools, it's the top of the hour. We're going to remind you. We're going to read what that scroll says on the bottom. Jason and I are here to give you our opinions. We are going to give you our thoughts. We are not going to tell you what you could do. We're not going to provide financial advice. We're not going to provide relationship advice. But please do get those questions in too, because I love those questions. We are going to tell you what we.
I mean, I'm willing to give people relationship advice, but not individual investing advice. Right?
The litigation is a lot uglier there. Actually, you don't want to.
No,
do
that's
that.
a good point. Okay, we're not crossing that line either. All right, fair enough.
Yeah.
Okay, so Lou, this is the valuation hour, right?
Yes.
Yeah,
which kind of fits into relationships too, but no, go ahead.
No, I was going to say, like, it actually, Ed kind of set us up later in the prior hour with a valuation question.
Yes.
And I like this question. And as I try to log on, 10 or 15 minutes before I come on to review some questions. And I decided, you know what, let's take Ed's question and let's apply it to some of the biggest, most profitable tech companies out there. So Ed's question, for those that are wondering what I'm talking about, when will an analyst say, yes, we are in a high PE tech bubble? So what Ed is asking for somebody to admit, again, I'm projecting, Ed, I'm putting words in your mouth, but my take of that is you're saying somebody just step forward and admit we're in a bubble with these tech companies, the high PE tech companies. So here's what I wanted to do. All right. And I cherry picked a little bit. I just said, well, what are the biggest, most profitable companies, especially the ones that are tied to AI? And I decided that I just run the numbers. So I'm going to pull up a screen share here. Our wonderful folks behind the glass, if you can grab this screen share and share it. So here's what I did. Started with Alphabet. What we have here is Alphabet's price to earnings ratio. Right now is about 21 times. Over the past 10 years, Alphabet's price to earnings ratio has averaged about 30 times. All right, Mike. So that's reasonable against this long-term average. I've got some caveats I'm going to throw in, Lou, after I go through this exercise. What about Microsoft, the biggest software company in the universe? I'm willing to say the universe. It's probably just the solar system, but maybe the universe. About 32 times earnings. So roughly in line with its long-term average. It's come down. The stock price has come down a little bit, but also its earnings have gone up. That's helped bring that multiple down. But again, it's in line with its 10-year average. What about Meta Platforms? I mean, they're burning all that cash, right? 36 times is the 10-year average, trades for about 28 times. Apple? Oh, we're starting to see something here. It is well above its long-term average. What about Tesla? Lou? Tesla, way above it. Now, there's some context here I decided with Tesla that was useful. Its earnings have come down. The auto business is weakened a little bit. Margins are not as good. So profits have come down substantially. They've been cut in more than half, right, from the peak. So part of that, with Tesla's PE ratio, is what's happened with earnings. But again, it's a lot less than its long-term average, 300 times. But again, a lot of that is because it was trading in the 1 comma club, which you don't want a PE ratio to be in the 1 comma club.
Right.
This is the one everybody wants to know, though. What about NVIDIA? 49 times trailing earnings.
And
average about. Go ahead.
Yeah. Well, this is something, just to give you another stat. I won't pull up a screen, but just to make the point you're making. All right. Over the past 5 years, NVIDIA's stock price is up 1,740%.
Yeah.
Even with the dramatic sell-off post earnings today, they're still down 2%. But even with this dramatic sell-off, you are still up over 5 years, 1,740%. During that time, NVIDIA's PE ratio is down 20%.
Right.
Which
Now,
is kind of the point you're making in a different way. Yeah,
it is. So a couple of things. Like I said, I want to qualify some of that, because on the surface it might look like I'm trying to say, Ed, you're wrong. What I'm saying is it's complicated, right? It's complicated. Here's what we know. Again, looking at those valuations against some of their longer term, and again, we're looking at a decade here, 10-year average here, to try to normalize it over lots of different situations with things that could have affected their earnings that are just maybe non-cash things, but also the environment that they're operating in, like the ad businesses that go through the cycle, like all that stuff, right? It's like trying to give us like some picture. But what we've also seen is that a lot of these companies, their earnings have just absolutely it's not just NVIDIA that's seen its earnings go up a lot. Microsoft has been an earnings monster. Apple's earnings are up a tremendous amount over the past decade. They're not up much over the past few years, right? The stock has continued to move up, but its earnings per share haven't necessarily moved up with that. Hence, its valuation from moving from well below its long-term average to moving to more in line with its average. But when I say it's difficult, what we don't know, and the reason I don't think any analyst worth their salt is willing to just kind of stand on that firm ground of this is absolutely a bubble, is we don't know what the monetization, like thinking about that Gartner hype cycle, like that's not about stock prices. That's about like the actual business, like the results of the business, the expectations of the results. We don't know how quickly the money that is being spent to build AI is going to turn into earnings per share. We just don't fully know. I think we know what it's going to look like 10 years for these companies, Lou. It's probably going to be a ton of money. It's going to be a ton of money.
Yeah.
But we don't know what it's going to look like in 2 years or 3 years, right? So there's just a lot of uncertainty there.
So yeah, a couple thoughts. I mean, I'm not going to stick my head out either here, but the interesting thing to me, and this sort of gets at last hour, they were talking about short-term, medium-term, and long-term for NVIDIA. And, it's funny, like when you break it down that way, and I don't know if you'd agree with this, I'd say long-term, I believe higher from here. Short term volatility all over the place. It's the middle term that kills me, or that I have no idea, because we are going to find out in the next few years whether or not that all of this of right now was sustainable and it kept going, or if we were just in the midterm pulling forward some earnings and we just have a baseline for a while. So the middle term is harder, which is sort of a way to get at this too, is that I don't think, based on business results over the last year, that valuations are out of hand. What I wonder is this last year an anomaly?
Will those trajectory of business results continue to earn the valuations?
Right.
Yes.
If we can continue what we have done with this group over the last year, it all makes sense.
Yeah.
And I do believe some of the value is sort of, whether you realize it or not, you're implicitly saying this will continue. The business will continue, not the stock. And I do think, and I'm not saying it's not, but I do think the kind of open question, or the two sides of a market right now, is at some point the trajectory will change.
Right.
I don't know if it's now or 20 years from now. God help us all if it is. We're all having boats. But exactly. But that's sort of what the PE question is to me.
I think so there's two ways I've been thinking about this, and then I want to invert this a little bit, because I think there's a more important question, a more important answer to Ed's question that I think will serve fools better to ponder. What will be interesting is when we start seeing the companies shift their posture on these aggressive capital spends. Is it going to be before or after the earnings starts to generate? And that's going to affect the trajectory of the stocks more than anything else, I think. So I think that's important to remember. So here's how I want to invert this a little bit. Ed, first of all, thank you for this question. I love the opportunity to have this discourse, because it's so valuable to have these are the harder conversations, right? It's great when we have a company that reported results and we love it, and it's good, and the stock's going to go up, and we can kind of all agree on things, but the hard things are more important to talk about, to get to the truth and to get to the better answer. And I think the way the average individual investor should think about this is less what's going to happen in the near term, what's going to happen in the long term, is how do we build our investing, how do we use our investing frameworks to get success and maximize the outcomes and minimize the risks in these kind of harder to really figure out what's going to happen periods. And I think the two answers to that are position sizing and knowing your time horizon. For investors who own some of these stocks that have been massive, massive winners and now represent a substantial percentage of their net worth, that are Lou, our age or older, meaning they're getting closer to needing to turn that wealth into money. That position sizing thing, I think, is really, really important. Maybe it is time, even if you do believe 5, 10 plus years, these stocks can continue to win, that near-term uncertainty creates a bigger risk to your ability to reach your financial goals. Maybe it is time to think about adjusting that position sizing down. If you're younger than us and we're in our mid-late 40s-ish kind of window, directionally,
I'll take that.
Directionally, I'm here to help you make you feel good about yourself, Lou. Then, and you are, but again, you're measuring still multiple decades. Maybe the time horizon is your margin of safety, where what happens in the next couple of years is less of a concern, because you're still adding money, and maybe they're not as large a percentage of your portfolio. And if we do go through one of those bad situations where they pull back on the capital spending because the monetization is not happening as quickly and other things happen, maybe there's just opportunities to buy at cheaper valuations, right? And it's not because they've grown into the valuations, but because the stock prices have come down, right? So I think answering that question, which is a hard one to answer, through managing how we invest, is probably where a lot of us should be thinking. Okay, I've said a
Yeah.
ton in the first 13 minutes, Lou.
Yeah. Well, and I'm just going to add on that one more second. That yeah, maybe it is a reflection of our age. As I keep going on here, I do have to pay for college in the fall, so I am thinking these way. But look, I want to give, because I know this is a little not taboo around here, but I know it's not dogma. This is your hall pass, people. If you have a huge winner, you are allowed to sell a little and feel good at night. I personally don't have NVIDIA, but I guarantee you, if I owned NVIDIA, I would have sold some last fall because I did it with a lot of other big winners, with Axon, with companies like that. I love the idea if I'm up some crazy amount by the grace of the markets and whatever else, the best of both worlds, have your cake and eat it too. Take 20%. It can be your cost basis if enough, find other opportunities and still get the upside. So yeah, definitely if you are up there in age, and Jason, thanks for admitting that he tries to compensate with that hair, folks, but he's just as old as I am. But definitely in that situation. But for anyone, go ahead, enjoy your winners. We don't know what will come. If they go up, you still own a lot.
Yeah.
If they don't, you can say, well, at least I got some of it. I like that as a mindset thing, but yeah, do what you want.
All right, Lou, we've got some actual valuation questions that are coming in here. Unless you see another one that you want to grab. Do you see one that you want to grab? Let me just ask.
No. Go for it. Go for it. There's a lot of good ones, but
well, there was the Howmet that cyber. It's the most recent question we've gotten. And
yes,
Howmet, you know Howmet, you cover that. You're familiar with that business a little bit, right?
Yes. So, and we won't go down this rabbit hole again, but yes.
Yeah. So Howmet, ticker HWM.
HWM, and what they are is they are a fasteners business mostly. They want to be other things for other people, but they make the little components and a lot of aircraft engines and stuff like that. And so the 2-second rabbit hole question, the thing here is that they were part of Alcoa. Alcoa, of course, is the aluminum commodity company. Alcoa had this great idea: if we don't want to be so tied to the commodity cycle, let's buy up some finished products, some products that use aluminum. Those sales hold up steady no matter what the price of aluminum is. And so that way we can kind of not just trade with the commodity cycle. Good idea, really poorly executed by a really, really bad CEO. It didn't work out. They split the company in half to go back to commodity and finished products as separate companies. That really, really bad CEO I mentioned, he stayed with the finished products business, and it didn't get any better. Okay. They finally fired him, which is why I can say this. And hopefully I don't think Klaus watches, but if you do, hi, Klaus. But what is left,
for those that don't know, when Alcoa did the split, this was I think they called it Arconic. I think was what they originally
Arconic
called.
was the split, and now Arconic has been split into two things, basically the aerospace assets and the non-aerospace assets. What we're talking about here is Howmet is the aerospace business. Okay.
Yeah. Yep.
So this is a stock, Jason, not quite NVIDIA, but it is up over 100% in the past year. Okay. Now, I would submit to you that while they've done a lot of good things, a lot of that is the moron discount getting taken off. And again, Klaus, if you're out there, please let's do lunch. But change a CEO, competent management, and look what happens. It is literally flying high. That's not going to continue. We have got the idiot discount out. So what we're left with, Cyber Mikey, I think you say it good. It's a really good company. It's got good diversification, but you are right. It seems a little, if not pricey to me, it seems like it's not likely for the multiple to increase from where it is now, because it is sort of trading, and I can pull it up in a second, but it's trading within range of some of the other companies. They do not have some of the patent protections that a TransDigm do. What they have is huge volumes and long-term contracts. They sort of got caught up even in the AI hype, because they make components for gas turbines, which gas turbines were going to feed the data centers. I think what the other side of valuation is you got to accept some of these, especially industrial companies, as they are what they are.
Right.
And you're not going to pivot to social media or something like that, which you're going to get a new multiple. I think, and I would say this about much of the aerospace sector, especially in the defense side, a lot of them got ahead of themselves at the end of 2024, and you've seen pretty dramatic falls. And I get a lot of questions on here about these companies like, wow, it's down 20% in the last 3 months. Is it a deal? I don't think Howmet is poorly valued right now, but I think they're valued about where they should be. So I don't necessarily think we are going to see another 100% year. And I think you're going to have to kind of go with the cycle from here. Now, the good news is the cycle looks very strong, where you've got a couple of years of airplane sales, demand for airplane sales, and still not companies that are able to make them at the rate that they need to make them. So I do think this can be a market beater because I think it's in a good sector over the next 3 to 5 years. I just worry that people look at that chart without the context and see 100% gains. And I would not predict that follows. Does that make sense, Jason, without actually getting into any of the numbers?
It does. I think one of the key things you talked about with Howmet is like when Arconic was split out, I was relatively bullish on the idea because it should be the value add part of the business versus the commodity side. But yeah, it's like an operating leverage play. If they continue to just be good operators and maximize their scale, it should do well. So, but like you said, this is no longer like the deeply discounted valuation because we don't believe in management. So
yeah. I mean, it's 25 times with debt included, 25 times it's the estimates on an EBITDA basis. That's not crazy, but it doesn't seem like to me it goes further. But yeah, at the end of the hour, maybe we'll give that Klaus Kleinfeld's home address and all of that too, so I can really pick on him. No, we won't do that. Yeah.
Let me take Matt's. We got a couple bank questions, so I'm pretty happy.
I know. I'm so excited about this. But Matt's question makes me mad. But go ahead. But
that's okay. So Matt says, "Fools, Jason's right to be hyping Live Oak Bank, ticker LOB, because Live Oak Bank went from a $400 million bank 10 years ago to one holding $11.2 billion in assets today." So, Chip Mahan, is he one of your top 3 favorite bank CEOs?
He is.
He's so great. He really is.
He's just smart.
Yeah. And he's the right kind of smart to be a guy that's running your bank. Mm-hmm. He's the kind of smart that's understands the inverted gravity of banks and that you can get all the capital you want. It's easy for bankers, right? To do it. It's what you do with that capital that matters. So I want to talk briefly about Live Oak. And I want to look beyond valuation. So it gets a little bit to the story we talked about with thinking about the big giant tech companies with AI exposure and like that uncertainty hole of trying to invest across that we're dealing with. And I think there's a little bit of that with Live Oak right now. So Live Oak's core business is lending money to small businesses. And their deposit base is largely regular people that just want to get a high interest rate on their savings. So they open an online high yield savings account or a CD. That's been the vast majority of their deposit, the cash that they get from those deposits that then they lend out to small business owners. A couple things. They're working to increase the depth of their relationship with the small business customers and actually become like full service banking partners for them. And they're starting to grow that. That's becoming a little bit larger portion of their deposits. But I like, Lou, that those two parts of the business are different, because if you're a specialized bank and you're targeting a specific sort of part of the market, and that part of the market is not doing well, if those customers are not doing well as borrowers, they're probably not going to be the best depositors either, right? So having a little bit of a separation there is good, and diversifying their deposit base away from their customer base, their borrower base, I think is good. I think also when I think about, well, lending to small businesses, that sounds really risky. Lending is really risky. You can take out that to small businesses part and just say lending is risky, or insert literally anything about lending, borrowers and say it's risky, and it is. So some things that they do that are smart. Number one, they know the SBA, like the Small Business Association, loan programs incredibly well, so that they can have as many loans that they underwrite that are guaranteed by the Small Business Association. That's really valuable. That's like if you're a mortgage lender, understanding Fannie and Freddie and making sure that you are, if you're lending jumbo loans, they're not going to be backed by Fannie and Freddie, that you're getting an interest rate and you're getting some loan to value that protects you against losses in case of default, right? So they know that process really, really well, and that's really valuable. They don't just lend willy-nilly. I think they started with vet clinics. Is that where they started, Lou? And then
vet clinics and chicken coops, I think.
Yeah, and they've grown from there and expanded into other businesses. They find businesses that are important, that have pretty good steady revenues, that their customers tend to have good discretionary income, that are resilient to recessions. So they try to get to know those industries well before they ramp up lending into them. So they do some things I think that are pretty smart to manage the risk as a lender. I think right now we do have 2025 for me for Live Oak's loan book, I think is a little bit in the too hard pile, because a lot of their customers are not super well capitalized, and between potential trade war, inflation, seeing some signs that that consumers are starting to get a little bit squeezed, that the growth opportunity might be kind of squeezed a little bit for the bank. So I think that for me, because the valuation is not super cheap right now, it's reasonable. For you buy this price and you hold it for a decade, I think you're probably going to be really happy with it. And there's a decent chance you're probably going to beat the market. But I do, and this is just kind of dumb Jason brain here. I feel like there's a really good chance that the market gives us a better price at some point in 2025.
I think that's fair. This is one of my favorite ones to come back to when you talk about the advantage of long-term investing, because I think I see a picture for the next 5 to 10 years for this company that might be different than what a Wall Street analyst who's paid to look at the next 3 to 6 months will see. And so we may have a different outlook, and we are both doing our job. And that is an opportunity. Chip is even older than Jason, and full disclosure. And I'm not really competitive about most people, but I'm competitive with Jason, Matt, as you know. I met Chip for the first time. I don't know the exact date, but it was before the .com crash. Yeah,
and he was still older than you back then.
Oh, he was, but we were selling his former bank.
Right.
We split it off. I was part of the team that split it off, and S1. He stayed with S1. Was it just S1 or anyway? But at the time, he had started Security First Bank, which was one of the first internet banks.
Right.
And they kind of realized, well, banking is for suckers. They sold that off to one of the North Carolina banks, and just held on to the technology.
And for those that don't know, the North Carolina banks include Bank of America.
Yes. Yeah. But it was, it was years before that. I want to say it was Centura, but anyway, so I'm really dating myself now, but, and so I met Chip then, and I actually bought into this IPO. So I think,
incredible. Yeah.
So, but that's what I think of him, but Chip has always been smarter than every other banker in the room. And the genius of Live Oak is that we're going to do only a couple of industries, and that has expanded, but we are going to know that industry better than you do, better than our customers do.
Right.
And it works for me, but small business lending, like Jason said, is a tough business, and this is a tough environment. I like this stock over 20%, over 20 years better, and I like it over 6 months.
Yeah, no, I think that's a perfect way to put it. I want to say one more thing about that. Knowing your industry, knowing your business better than you do, the owner of a business in that industry. It's not to figure out where to go say yes. It's so they know where to say no.
Mm-hmm. Well, and
banking,
also
that's what you need.
And also because it's funny because I did my due diligence when I was stuck when I had a dog who was sick years ago, and talking, and it turns out, like, nothing's better than, hey, who's your banker, right, when you're sitting with a veterinarian. But just, that would rave about how, oh, Live Oak knows what we're going to need before we do, because we are, a 3 doc veterinarian practice, and they will tell us, okay, this is what all of our 10 or 20 doc veterinarian practices, that's the products they have that you don't have yet. So that's what I mean, knowing the business, like actually almost serving as a free in-house consultant for a small business because you know the industry that well. That's the type of relationship that you just don't drop because someone offers you a penny better on a dollar. So that has been how they've worked. And also, by the way, not to go too off on them, but 3 or 4 times they've won the best bank to work for in the world. They had doggy daycare in Wilmington before anybody did. They let you bring your kids in. They set up daycare for free there to try to get more working parents to come work for them. Just a really, really well thought out company.
Well, in Live Oak, they do a lot of seed investing in
Yes.
financial tech companies too.
Well, the other thing, and actually that's where I was going to go with the security first thing is Encino, they call it, I think.
NCNO is the Chip Mayhem was the founder of that business.
Yes, and that is affiliated. You get that, but a few years ago, they kind of, I think investors missed it. They got ahead of themselves with it because they didn't realize. They basically were running a venture fund in there, and it had a big payday, and it looked like, wow, this bank is doing. But yeah, so there's just this is a trust the jockey for me. But yeah, I really believe in it over the long term. But as you said, that is not a prediction of the next few quarters. Other than I think they will walk out of it on the other side of it still intact, and that's what I'm looking for.
Yeah, Matt, thank you for getting that question in. Love, especially with me and Lou both. That's one we could talk about for a long time.
Yeah, I'm getting a little teary-eyed. Yeah, anyway.
So R.I. Red asks, Jason, what are your thoughts on NTB valuations? So NTB is the Bank of NT Butterfield and Sons, better known as Butterfield Group, is the corporate parent name, but the Bank of NT Butterfield and Son is the banking retail name. So this is basically an offshore bank, Cayman Islands, Bermuda, the Channel Islands, basically a bank for wealthy people, like elites. Offshore banking is what they do. A couple of things I think that are interesting. You look at the valuation, and it's really cheap right now. It trades for less than 8.5 times trailing earnings. I think the earnings are probably going to be relatively steady this year. Dividend yields about 4. What's that?
Yeah, they had a great quarter earlier this month. So yeah, go ahead.
Yeah, and that really, from a valuation perspective, makes the stock look super cheap. And it's cheap, but I think it's one of those that always trades for the low end of multiples. And with banks, you have to remember, banks always trade for most banks almost always trade for a substantial discount to the market, because people think of, well, banks have all the money. No, banks have all the debt, right? So for every $10 that a bank lends out, like $9 of that they owe to somebody. It's somebody's deposit. That's why the deposit is a liability. If you look at a bank balance sheet, and about $1 of that is usually the bank's capital, right? The equity, I should say, right? So banks are very, very leveraged, right? And when we go through economic downturns, people can't pay their bills, can't pay their loans. Banks bear the burden of that. So that's why banks trade for a pretty big discount. But this is a pretty sizable discount, and I think part of it is because there's the bank has dealt with some growth challenges over the past few years that I think it's actually answered in the past, like since it went public 8 or 9 years ago. There was a lot of growth at first, and then during the pandemic, it actually didn't do that great. Partly they made some not great decisions with some investments they did. They bought a bunch of mortgage-backed securities at pretty low yields. It's still waiting on the returns, but their fees-based business has grown. Some acquisitions they made to grow their retail footprint. They moved into some markets where there are opportunity to provide more high touch fees based services have helped a little bit, but their net interest income was up a ton here more recently. But we haven't seen the dividend grow very much at all in the past few years. What's interesting to me, Lou, is that even though the stock price really hasn't done very well over the longer term, they've almost 4x'd their earnings per share since going public. Earnings per share is up about 251%. So it's lumpy growth, but I think long term, this is a really good, steady dividend, high floor, maybe not a super high ceiling business, but it should just be a decent compounder that pays you a good yield. Like I think about this as like long term, maybe better than a bond if you're just focused on the income. You're going to capture a good yield. Your total return is going to be excess of what you could get from a high quality bond.
Yeah, we talk about valuation a lot, and it's hard to do valuation on some of these, and it is this is a lazy approach in a way, but it sort of works for me as at least as a guide stick with banks, because as Jason says, it's a pretty simple business. You're buying and selling money.
Mm-hmm.
You know, you don't have the annoying thing like factories and widgets and transportation and all that get in the way. So I tend to almost like with REITs, I start with dividend yield and then work my way backwards from there.
Yeah.
And full disclosure, this is one that I added. I think I basically doubled a position in about a year ago. And it is up from there. But this is a bank that I think for all the things Jason say, I don't think it's a no-brainer, but as an income stock or as a mix of income and incremental growth, you know, I think this one works. So yeah, I like that. Jason has just run off, but I can try and get at one. And this is all sorts of trouble I need input is trying to get me into, but we'll try and think through it together at least as an exercise. It says, hey, Lou, I know you're a big Aircap fan, AER. Yeah, we talked about it last hour. Any best guess on what the market cap could be for Aircap in the next 10 years? Gosh, that's trouble. But let's try and break this down and at least do a thought experiment. What I keep ranting about with Aircap is that I think it deserves a premium to book value, but it is only basically trading at book value. So we are going to now, first of all, assume that Aircap over the next 10 years, we won't break that cycle and it will continue to trade at book value. And it might be because, look, if you look at the balance sheet, you're going to run scared from this because Aircap, the raw material is debt. So it always looks like it's got a stupid amount of debt. And maybe that does just limit the appetite on the market on this. But while I can't begin to guess where the market cap of any company will be in 10 years, I can tell you that over the last 10 years, the company has grown its book value at a CAGR of about 6 to 7%. Okay. And that includes, by the way, the pandemic and what that did to aviation then. So I think that that's not, I'm going to hope that we don't have another pandemic in the next 10 years and we have a more normalized rate. But I think that CAGR is achievable because I think the fleets are growing and I think more people are going to do this. So if you just take the current book value, which is, I don't know, about 17 billion on an $18 billion market cap or 18 billion, and apply that CAGR, you're somewhere in the 30s. I don't know if that's accurate or not, because then you're going to have to tell me, is it really, if they can do that, are they still going to only trade at book? But and also there are limits to the size of the aviation industry. We don't know. But again, my biggest fear with this is that I'm not wrong, and some private equity company is going to agree with me, and I'm not going to get a chance to own Aircap anymore. But and honestly, I think that is almost as likely as us figuring out what the market cap is in 10 years. But I just see an entire global aviation industry turning towards these sorts of businesses. This is the dominant business in the field, and it happens to have the best management, the management team that basically co-invented the industry. I like my chances. So very, very lazy, bad, poorly thought out experiment, because I don't know how to predict 10 years into the future. But I think just looking at the last 10 years, maybe. I don't know.
Maybe that is just the most satisfying
Maybe.
answer to give people on this show,
Yeah.
Lou. Maybe.
Yes.
Maybe.
Yeah. Sorry, I need input. I can't give you more there, but that's at least some thoughts on what it can do. And we'll learn more soon. The other thing is that I do think the dividend's going up from here. So maybe that'll finally kick people off the sidelines on the stock. But we'll see. Maybe we'll see. That's even better. Yeah.
Even better. Yeah, even better. So put some window dressing on your maybe. So Logical Dreamer says, how about the valuation of companies like Team? That's Atlassian, the ticker's TEAM, and other small to mid tech. They seem to be very expensive. So I want to say it's interesting what's going on with a number of those businesses, because Lou, if you think about Atlassian, we could put it kind of in the same bucket with Zoom, Asana. Pick a SaaS company, right? And you go back to 2021. It was really like the fall of 2021 that was kind of the peak for a lot of those companies. They started selling off first, and then the S&P 500 peaked in early January of 2022 before we went through the big, the bear market. And during that, 2022 sell-off, before I think we bottomed in September, October, most stocks kind of in the fall, early fall, was kind of the bottom period before the recovery that's made the past 2.5 years so rewarding. A lot of these stocks now look very expensive compared to where they were 2 years ago, right? During that bear market. That's not to say they're not expensive. For example, Atlassian trades for 15 times sales. Full caveat here, price to sales ratio to me is empty calories in a lot of ways, but directionally it can be useful for these companies like Atlassian that are not profitable, exactly. Right? You're using it to
the problem.
Yeah. So that's the thing. Like, you can't use it just standalone. You look at it, Atlassian's generating positive cash flow, trades for 51, 52 times operating and free cash flow. It generates and converts most of its operating cash flow into free cash flow. That's up a ton from where it was. Where you have to think about a lot of those businesses, and Atlassian's not a new company. It's been around for well over a decade, but it's gone through a transitional period, some changes in leadership, and it has started to make improvements, and the economics of the business have gotten better. So it's thinking about that 50 times free cash flow. What are the growth rates of its free cash flow per share going to be over the next 5+ years? And is my holding time period part of the margin of safety where paying 50 times free cash flow can still make that a good result? So I think that's how I'm thinking about some of the Atlassians of the world right now. I don't own an Atlassian. I kind of gave up on them I don't know, maybe 4 or 5 years ago, just because they were really struggling. All of the work and things that they had done, just not making any money. I gave up, and I haven't followed the business very closely. But again, the key is with those sorts of businesses, that's the old saying, right? We're all growth investors on the way up, and then we're value investors on the way down, right? So the framework I use for thinking about the valuation of some of these businesses that still have the higher rates of growth and the bigger addressable markets to grow into, time I think about more as far as the margin of safety. If you're going to overpay for a business, do it when it's still relatively small and has a lot of potential growth ahead of it, right?
Yeah. Logical Dreamer. I don't know if it speaks to my age or just the industries I cover, but I love that a $75 billion company is small to mid. But I think I gave that. I think I gave a $75 billion company as a strong conviction large cap the other day. So that probably says more about me. But
it says a lot about you, Lou.
Yeah. In general, and I think this is definitely true of Zoom because we've seen it with Teams. But so many of these SaaS companies, in hindsight, kind of look like features for a Microsoft of the world.
Yeah.
And Atlassian, to their credit, what they do is complicated enough and ingrained enough that so far that hasn't happened. And, like I say, I don't think that they're going to get zoomed to, I mean, gosh, it was bad enough when Zoom became a noun. You don't want it to be a verb now with with what's happened. But I do think that, it's like a constant thing. It's like it's I believe two things, and the combination of them keep me on the sideline. It's a very sticky product that is, even if we're all back to work now, collaboration tools and automating collaboration really, really matters. It's not just when we were all at home with the pandemic, but competition there is intense, and it's only going to get more intense as big tech gets bigger and finds new ways to do things. So that does just scare me away from a lot of these personally.
All right. So you talked about Aircap.
Yes.
So Ed, we got a couple questions here about Brookfield. So Ed, when I popped in earlier, Ed pointed out that he got his Schedule K1s from Brookfield. Yeah, those are slowly coming in. Fools out there, if you own any publicly traded partnerships, I think they have until like March 15th to get those K1s out. So still got another couple weeks for those. But John Gallego says, "Good afternoon, gents. John, it is always wonderful to engage with you. Have you talked about Brookfield infrastructure? I feel confident that Brookfield Corporation will hit their price target of $176 in 2029. So a lot of comments there. And I want to talk about Brookfield briefly because I watched an interview that Bruce Flatt did today. He didn't do the interview today, but I watched the interview today that he did with Bloomberg. And one of the things that I think is so important to remember about the Brookfield businesses and the asset management business and the operating subsidiaries is the mental flexibility of its leadership that's bolted onto a bunch of value investors. One of the things that Flatt pointed out is that if you look across a lot of their core businesses, a lot of the investments that they've made, the things that they've acquired, they didn't really exist 20 years ago, right? Like utility scale solar was sort of becoming a thing a couple decades ago. And now that's where they're investing the bulk of their capital, and energy storage did not exist in the way that it does now. Data centers, you look at their Brookfield infrastructure business, data centers for accelerated computing. It's a thing that didn't really exist a couple years ago. That's real infrastructure. That's global infrastructure now, right? So having like the mental flexibility to think about these different categories and places that sometimes we think are stodgy, boring, low growth. Like we think about pipelines and roads, and when we think about infrastructure, and power lines, we don't think about things that are like driving high tech. And having the mindset and the corporate culture, I think, is really, really important for Brookfield Corporation to hit its pretty aggressive price target by 2029.
Yeah, that's that's a call. I mean, I know we don't do calls like that, but at 176, it's around 60 now today. So that's ring the bell with, where's our klaxon or something? That's a great, but look, I'm not.
All right, stop it, Kramer.
I'm not going to bet against Brookfield. It's funny. I go back and forth on this because in a way I love the corporation, because I do think they're very smart people. We were talking about books earlier, and I mentioned Howard Marks. I mean, if you can bring that guy in house, you must. I mean, for
those that don't know, Howard Marks, founder of Oak Tree Capital, which is, I think, 75% owned by Brookfield now, roughly.
Yeah, and I mean, I just think enough of Howard that if he's willing to hang with you, you must be pretty good at what you do. So
right.
But in a way, I still prefer the spinoffs, because I look at that, and like there's a lot of areas like infrastructure and energy and stuff where I don't want to pick projects and pick winners, but I really, really love having smart people that can, so
right.
so I kind of I own a little bit of both, and I usually, if I'm going to add to the stubs, but I it's probably to my own detriment, because I mean, if my thesis for getting into all of those is I really think these people are smart, why not buy kind of the company that that houses all that intelligence too, right?
I'm gonna rain on John's parade a little bit here. Of producers, I've got another screen share I'm sitting across here. Don't be too sad, but what you
176,
what you have to, well, it's not that,
not 179,
right? It's not. I'm gonna assume maybe John had a little finger flub there, but here's
Okay.
the thing. Here's the thing. That's the Canadian shares, not the New York Stock Exchange shares.
Mm-hmm.
So
Okay.
so they're not saying that it's going to go from 57 to 176. Notice the single line. That's Canadian dollars. It's not the double line. It's the US dollar. So still going to be a market beating. What's that?
I'd still take it. Yeah.
Oh yeah. No, that's still an
incredible
incredible return. It's 2025, y'all. That's 4 years from now.
Mm-hmm.
And again, they're talking about 16% CAGR, right? So that's you take that in any market environment. You can't look at the past 2 years and say, okay, I got to do better than 16. No, you take 16 every day and twice on Sunday. That's just an incredible result. So, all right.
Do you want to talk lemonade?
Yeah. Why the heck was it up 18% today? I don't understand. I couldn't figure out, and I'm in it. Full disclosure, I didn't spend a lot of time looking for it because I had other actual stuff to figure out, and it was more of a curiosity. Because Lemonade reported the prior day, and the stock actually sold off a little bit.
It sold off quite a bit. Yeah,
it did, and which was interesting because the results were very, very good. The lowest gross loss ratio, and some other fools and people I've engaged with on social media have pointed for good reason. So what about the combined ratio? When is that going to get below 100%? And that's a really good point. So, and the growth rate, like their total growth of their insurance book, the growth rate for their guidance for 2025 is that it's going to slow.
Yeah.
And they're planning to spend more money on customer acquisition. I think that's why the stock sold off after earnings, is they said, well, you know what? We're still going to grow our insurance book about 29% this year, but we're going to accelerate our growth, our customer acquisition spend. And the market said, if you're going to spend more money, we want to see that accelerate too. And that's not what they're guiding to. Okay, Lou, what have you learned?
Well, so maybe you were talking about the weird sell-off post earnings and the weird jump today. The whole weighing machine and voting machine over the last 5 days. It's off less than 1%.
Yeah.
So which seems more.
Yeah.
So it's funny, very different business. But and I'm talking about Jimbo's question is Lemonade a buy after report improvement in gross loss ratio, but what about combined? So exactly what you're saying. To me, I'm going to compare this to a second, and I know it's not the same, but to another fintech darling, Upstart.
Yeah.
UPST. Because in a way, we're still just sitting there waiting to figure out if the fairy tale has a happy ending, right? We are still kind of waiting to see how
cynical.
Well, no, I mean, look. I all right. So I shouldn't say fairy tale if the story has a happy ending, because we know they've set up something. They're trying something kind of different. More so probably an Upstart, because Lemonade is more of a marketing story right now, I think.
Right.
But we're kind of just okay. They've done this. We see some signs of good. We have reason to hope. But we're not to the finish line yet where we can say, yes, this works. To me, insurance has always been about two things. There's underwriting and marketing. Okay. And you have to be good at one of them, and you have to be able to at least tread water in the other.
Right.
There are a lot of examples of companies, like Progressive and Geico, who their underwriting is fine, but they win on marketing, right? So as long as you get that one thing going, the other one just has to not fail you, Lemonade is kind of in a similar thing. Like they have won marketing, but they have to get some people in the room post haste that make sure they can at least survive on the underwriting side.
Yeah.
They've done that. They've
five
brought in
five quarters in a row, and the
Yes.
past 2 quarters
Yes.
finally
and
like below that 75% threshold that they're saying, like at scale, if we're consistently below 75,
right,
we're going to make money.
right. And they brought in some grown-ups to get there.
Yeah.
And which is good. So they're kind of there. And so now we're just going to wait and see. Okay. They say we're there now. We can scale. If we can scale, we can do it. So they are they're climbing the hill. They're getting there,
Right.
but the jury is, but we're not there yet.
Right.
And that's
Right.
sort of like, again, with Upstart, everything is trending in the right direction, but we're not there yet. So is it a buy after the report? I think if you are a long-term holder and you have a long-term perspective, however good you felt about it 2 weeks ago, you should feel better now.
Yeah.
But
if you believe that directionally the improvements in underwriting bolted onto a good marketing story and what seems like excellent customer service, like that end of everything they do, if you believe that directionally that's going to continue, Lou, I think you're absolutely right. Yeah.
Right.
I think you're right. Yeah.
But there are ifs there. And with scale and is when customer service gets into your way too. So I don't think it's settled science.
Yeah. Well, there's one other thing, and your friend and my acquaintance Jeff Santoro dropped in he's coming on the next hour, put adjusted EBITDA guidance in our studio chat, and so that there was a little bit there. I think part of the reason that their guidance was lower was the losses that they're expecting to take based on the California wildfires. I think it was like $20 or $30 million.
Yeah.
And I think maybe there was an expectation that maybe reinsurance might be covering more of those losses. So, I mean, you got to remember all that stuff happened in the quarter they will report next. So they just kind of offered that. So I think maybe that was part of the sell-off. But it is interesting that the stock recovered so much today. But they're saying, in the next less than a decade, they're going to 10x their insurance book, which is substantial. Because if you get to that sort of scale and all the things they're doing with technology continue to deliver the efficiencies, this could be an exceptionally profitable business and worth far more than it is today. So that's the upside. The downside is
I do think, without going too deep, but just to compare it to the other insurer that I think, Jason, no, you weren't on yet when we were talking Kinsale before the end of the hour, but
I was watching and I was smiling and I was happy. Yeah.
That I don't need to know that, Jason, but none of us need to know that. But one of the things I really respect about them is their ability to just kind of say, okay, now no growth mode because of industry market conditions.
Well, they price risk. They don't price growth.
Right. They would rather lose the business than get into a bidding war for business.
Right. Exactly. They'll lose the business versus writing an unprofitable contract.
And a year or two ago, that was the knock on Kinsale. They stopped growing as fast, but it was a time when insurance were very flush and were aggressively looking for places to put that capital and coming into the E&S. I
want to add one more thing here. You mentioned Upstart because
Well, just
go ahead.
Real quick on Lemonade. Yep. I do get a little scared when finance type companies, insurance banks, whatever, start talking about, rapid growth. And not that they can't do it, but just if you're an investor in it, just let's make sure that they keep Kinsale's good advice in mind about
grow the right way.
Grow the right way. And again, not to say they won't. So Jeff, I don't need you to yell at me in the comments, but but just
But to the greater point, one of the things that Lemonade has stressed is that because of their operating model, they believe they can get to those targeted loss ratios at lower premiums than their competition.
Mm-hmm.
Right. Mm-hmm. I think that's the key and we're going to find out, right? We're going to find out one way or another, I think is the key. What I wanted to say about Upstart is the differentiation I have between Upstart and Lemonade is that Lemonade controls its destiny more than Upstart. Upstart depends so much on capital partners and lenders versus Lemonade, which is selling directly to its customers.
Yeah.
So that's we're seeing those customers are far more willing to now actually start using Upstart's platform, right?
Yeah. Yeah.
So that's
yeah. No, I mean, I think it's much. I mean, in a way, too. Upstart is trying to do something new. Lemonade is just putting a fresh spin on something that's been around forever, too. So, I mean, in a way, the glass half full is that maybe there's more upside for Upstart because they are. I think Upstart is more of a disruptor.
Yeah, no, I agree 100%.
Lemonade is basically
just a competitor.
Yeah. They're a tech-inspired marketing company, and again, it can work out really well. Upstart is trying to reinvent the wheel, and
and the evidence is that maybe they do have a better mousetrap. So we can go ahead and mix metaphors here.
And I would say let's finish on Upstart because we're about done, and I know Jeff can't stand.
Well, before you do that though, I do want to just one thing really quick. 307 Fool, are you guys heading to the Berkshire meeting this year? Really want to get to one while Warren is still around. So Jeff Santor and I are planning to go. A couple of other fools I know that maybe are going to go. I'm not going to, I'll let them decide to disclose that once they get closer to a firm decision. But I do think there will be some fools there. So let's keep in touch. Okay,
I would really like to, but I have a high school graduation to worry about.
You have those only happen once. They're not like weddings that happen on multiple times.
Yeah,
so.
I thought her senior year might happen twice, so you never know. But just on Upstart, and this is just kind of instead of going somewhere new, the one interesting thing to me about as a long-term holder now is that my vision on what success has changed so much with them. I have talked myself into the fact that they can't replace FICO, and it's not because FICO Fair Isaac is that good. I think that everybody is going to replace FICO. What has AI done to me?
That's right.
I think that the Capital
It's not the replacement, it's a replacement.
Right. I think that the Capital Ones, the Bank of Americas, the JP Morgan Chases of the world are going to see the ability to score credit as a competitive advantage, coupled with they are all tech savvy, and the fact that with AI you can do more things, that we aren't now in this almost binary race, like what works better, the FICO score or Upstart. What I like about this is, though, if the world moves in that direction and the big banks sort of go in-house, the ma and pa community banks will not be able to follow with their technology stack. So they are going to have to, in a world where sort of the FICO score fades, they are going to need an alternative. If you really want the kind of dumb guy bull case, I really think it's that we could be looking 5-10 years out where the credit unions of the world are looking for a partner who can do this. So
if you look at Upstart's press releases over the past 2 years, that's what the bulk of the new partners have been, our credit unions.
And years ago I kind of thought this is going to be a one or the other. But anyway, that's we're not even answering questions that people have now, so someone needs to get me off of this, right?
So we should, I think Jeremy Bowman and Jeff Santor are going to be hopping in here any moment now. While they're coming in, Ed asked me a little while ago, what's your opinion on Zoom? I've kind of given up on Zoom. I sold my stock late last year. And part of what they reported this past quarter is the reason why. The growth rates are very low. Their margins are starting to get squeezed. They have all of this cash that they're showing little interest or ability to leverage that cash in ways to create per share value. Like even the stock buybacks, they touted like $15 billion in stock buybacks. They ended the year with more shares outstanding that they had at the beginning. So I really have, I need to see, I will buy Zoom again if they show they can create more per share value. But so far that is yet to happen. So I moved on, which probably means the stock's going to triple over the next 5 years.
Speaking of moving on, we have to say goodbye to the YouTube audience. Fools, hang on for 1 second. You're going to see a nice video clip, and then our pretty faces are going to be replaced by Jeff and Jeremy. I'm going to leave you to decide whether or not that's an upgrade or not. And on that note, thanks everybody. Jason, always a pleasure. And take it away, Adam. Do your magic.
Well, hello and welcome, Fools. We're now into the final hour of Fool24. I'm joined by a very familiar host, Jose Najarro. How are you, Jose?
Pretty good, Will. Pretty good. I mean, I feel like after today, I'm gonna get a nice needed rest. Usually this week is probably one of my busiest. Um, and obviously NVIDIA earnings were yesterday, and today was more like a digest day. So after today, I'm probably gonna be sleeping for a while.
Yeah. Well, darn, I was gonna have you do all the work for this hour. But anyway, but I probably could do that to Jose if I wanted to, because we're having a chip stock hour, which is of course Jose's wheelhouse. So if you have to do a chip stock hour with someone, you want it to be Jose. So very happy to have him on board. So as Jose mentioned, and as Danny and I discussed in the last hour, that the big earnings report of the week was NVIDIA, and that's, again, they turned in a very impressive earnings report, growing revenue by 78%. I will, as I was alluding to earlier, I almost kind of hate to trash that in a way, because 78% is a very impressive growth rate. Unfortunately, it was less than the 95% in the previous quarter, and the triple digit revenue growth NVIDIA had for the last 5 quarters. But as I said, I think I think NVIDIA's revenue trajectory right now is kind of going through a natural slowdown. You can't really expect any company to grow at triple digits, especially a $3 trillion company such as NVIDIA. It's at some point you run into the law of large numbers. So if NVIDIA doubles from here, it's a $6 trillion company. If it doubles again, it's a $12 trillion company. As I mentioned, I think we're going to be a few years before we get to a company that's the size of 12 trillion. So, yeah, unfortunately, I think
A few years, right? Right. Well,
Yeah.
I think we're still a nice amount of years away for that.
Yeah. So I think I think that growth is going to slow down, just because I think the law of large numbers pretty much dictates that. But nonetheless, NVIDIA is still at the center of AI, and like I said, I don't see anything changing that for quite some time, no matter what that stock happens to do, over the next year and beyond that.
Yeah, definitely. Well, and hopefully maybe today for this chip hour, we can kind of, even if there's questions, or look outside of NVIDIA, because obviously there's a lot of semiconductor companies in this market, and we kind of took a heavy hit on a lot of them today. I know. First, back to this NVIDIA point. One of the things that really excited me, though, Will, is in this company now produces, if you look at their fiscal year, they had more free cash flow than Amazon this year. They had more free cash flow than Meta Platforms, Will. There's only 2 companies that had better free cash flow in the Max 7 than NVIDIA. And one of them is Apple, and I'm gonna make I made this statement, I think, yesterday when we looked at it a little bit, but I think this year, if everything goes as planned, this company is gonna be the biggest free cash flow machine in the Max 7.
Yeah, I have trouble arguing with that, just because the growth is so quick. It's still going to be fairly rapid, even though, as Danny pointed out in the last hour, it's going to slow down a bit, but just there's still just a massive amount of growth. So I'd be very surprised if NVIDIA wasn't the biggest cash flow producer 2 to 3 years from now, to be quite honest with you. So,
and Will, I know I think previously, and it's been a while, I think, since I've discussed this with you, but I know previously you've been a shareholder of Intel. Any recent thoughts on that company recently? I know there's been a lot of rumors in the past few weeks about maybe the company splitting off, maybe the company getting in a joint venture with some other players. Recently, we've also had the CEO just leave the company about two months ago. Any thoughts on this one, Will?
well, I still have a very small speculative position in it. I had that position basically because I was optimistic about the foundry business. There's a lot of political pressure to produce more chips in the U.S. Intel is still the biggest foundry company in the country, so in a sense, they kind of have to succeed there. However, when Pat Gelsinger left the company a couple of months ago, they put in some finance people, which kind of rubbed me the wrong way. But I kind of, I kind of figured out from there that I thought that they were going to try to sell the company. It looks like that might be the case if the rumors are true. So the fact that Gelsinger left told me they'd given up on their plan to catch up to their rivals, which I thought that was I thought that was stretching in the first place. But I think when AI accelerators came on the scene, it went from remote to almost impossible. That plan to catch up technically. So I really think it is going to split off, whereas some another company will take over the existing chip business, which it's a still pretty huge business. I don't remember the revenue of that business, but they still produce a lot of revenue. I think it's become more of a commoditized business, which is a decent for a business, but not really great for investors. I think that the foundry company will be separate. I don't know if TSMC would take it over, or if the various governments would let TSMC do that. But I really think they're trying. I predict a split up here, to be honest.
Yeah, I mean, I wasn't a shareholder, Will, and I'm still not. But with Pat, I think it had the best chance of success for Intel to at least had the best chance of success of turning the ship around. I think Pat was an amazing CEO and was definitely the one that had the best long-term mentality for Intel. I think a split up might create great news for investors in the short term of things. It might kind of create some excitement on the stock, and it might obviously benefit investors in the short term. But I think at the end of the day, the best route for Intel in the long term of things would be to stick together. There's this very popular semiconductor person. His name, I believe, is Joe Moore. He owns private companies. I believe he's one of the, I don't know if he's the CEO or the CTO of a very popular AI accelerator company called Tensor something. But he mentions that there was a random post on X, and he was like, a great Intel is $1 trillion company. And I think that's really true. If Intel would have been able, or is still able, it's not game over, is able to turn around and be the manufacturing giant, even if it's not the greatest manufacturing, but if it becomes a manufacturing giant, and if it continues to innovate in its chip design, that would have been one of the companies I thought would have gotten to $1 trillion before some other players. So it's definitely sucks to see the CEO leave. And it's going to be an interesting next few months, I think, for Intel, maybe even half a year before we really get to see some of the final thoughts of what happens to that old giant.
Yeah, I kind of have some affection for Intel. I made a lot of their money off their stock when I was first starting out. And I think the founding generation is who made it a dominant company. Their only flaw is they were not able to pass that off to the next generation. Had they passed that off to Gelsinger, who knew Andrew Grove, immediately, maybe the story would have been different. But they picked the wrong leadership for a long time, and that's why they fell off. And I don't really see a scenario where they catch up technically. So that's why I was thinking maybe a split would be best. You are the semiconductor guy, though, so I could be wrong about this.
No, I mean, I think there's in the scenario, I think it could be great for the manufacturing push as well. I think either or would be, maybe it's just my preference, Will. I think maybe as a joint unit, I think it would have multiple growth opportunities. If they split up, the specific segment that they're working with could still do amazing. And could be a great returner over time, depending on whatever happens to the stock. But I think together Intel has more growth opportunities than a split up Intel.
Yeah.
But I think both segments could do really well.
Yeah. Although historically, company splits have been very good for after a company split, the sum of the parts was worth more than the previous whole in a lot of cases. Yeah, I guess. The big historic cases are the the split up of the old AT&T back in the 80s with all those companies, and then Standard Oil back in the 1910s, which is, I don't follow the energy industry that much anymore, but I know a lot of those original parts still exist, and they grew much bigger after that. So I think a split might be good, but again, you're the semiconductor guy, so maybe you're seeing something I'm not.
No, I mean, AMD is a perfect example, right? Well, I mean, AMD split up from it used to have kind of the foundry business and then the design business, and it decided to just do design instead, and Global Foundries kind of was born out of that. And AMD is a way bigger company outside of that. So again, I don't think there's a wrong answer, but I do have a preference. Will, we got a question here from Pro Shop Guy about 5 minutes. What is the state of cloud computing implementation? Seems like hyperscalers need to grow computing power for cloud computing as well as AI. And definitely, Will, I mean, we've seen, I've two earnings that I definitely have read and really studied were, one was Amazon, and I actually forget the other tech giant, but it was another cloud player, and both mentioned that if they had more capacity, meaning more servers, they would have been able to grow their cloud space even bigger. So right now it's telling me that the cloud market is still supply constraint. There's plenty of demand. And obviously one of those reasons is we are seeing the AI space, still growing. And we're still needing massive computational there. But we've also heard that there's this other process called accelerated computing, where traditional software used to run on CPUs, but now we're kind of moving a lot of those CPU-based applications to GPUs, which is also increasing the demand for more high-performing servers. So I think based on what we're hearing from big tech players, even though cloud computing has probably been here for now almost a decade, maybe a little bit over or under there, there are still companies that are still moving to the cloud. There's still solutions that are moving to the cloud. And as new applications are born outside of AI or inside AI, you're going to need more cloud computing solutions as well. So I think the clouding space is still a very bullish market, with or without AI.
Yeah, but it certainly helps to have the AI. Yeah, we haven't been really talking about the cloud as much since AI has been taking up all the attention. But at least according to Grandview Research, they estimate the cloud will grow at a compound annual growth rate of 20% through at least 2030. So as Jose mentioned, a lot of companies still have not adopted the cloud, especially smaller companies. And I was talking about DigitalOcean in the last hour. I think they're going to play a huge role in getting some of these smaller enterprises onto the cloud. But yeah, there's so much more to do with the cloud. It's going to play a key role in all organizations at all levels implementing AI. So it's going to remain strong, even though even though we haven't focused on it as much, even though investors haven't paid as much attention to it.
I like this question here from Sadaf, Will, about a minute ago. What are possible acquisition targets of NVIDIA? Will, if you would have asked, if I would have been asked this question just maybe a few years ago with the way the regulations were for acquisitions, I would have said NVIDIA is too popular right now and they wouldn't make too many acquisitions. I think right now, NVIDIA is going to make a lot of small acquisitions. Well, we've kind of seen them do a few already. It's going to be small acquisitions in improving their software solutions. So I don't think NVIDIA has any real big target at the moment. I can't think of anyone in forms of a big target player of where they can expand. I mean, they already provide a vast amount of solutions. They have the networking with an acquisition through Mellanox. They already have the CPUs, the DPUs, the GPUs. So in forms of hardware, I can't see them buying a company. I think it would be more software based and more AI based as well, where they're trying to buy more talent and increase their software moat a little bit better. So I don't think there's any semiconductor public companies right now that I would see as an acquisition target for NVIDIA. Or maybe a robotics company, but again, I don't think it would be a public company. I think a lot of the acquisitions that they will be doing, and I think they're going to be doing a lot, is going to be more in the private industry.
Yeah, so I did see a question I wanted to address for this show, since we're doing chip stocks. T Stock asked about 9 hours ago, could inventory buildup at NVIDIA be related in part to geopolitical concerns, tariffs, and possible China invasion of Taiwan, Russian threat in Europe? This question, it always comes up, and it always comes up because the majority of chip manufacturing happens in Taiwan, which, if you follow geopolitics, China's been making rumblings about possibly invading it, and that's frankly predated the semiconductor industry itself. So I think that's a lot of the reason there's so much concern behind it. At the end of the day, we don't know what's going to happen there. I do remember that Warren Buffett's company Berkshire Hathaway got into TSMC, and Buffett insisted they sell the stocks a few months after because he was concerned about this very issue. I'm a little bit less concerned about it. One, because there's been so much noise about it for so many decades and nothing's happened. And two, I think China might. I think they're still in a position where they would be hurting themselves. Yet they can have Taiwan or they can have the technology, but they probably can't have both. And I think they're going. In my opinion, they would probably choose to have the technology. So I haven't worried about this. Again, anything could happen. I could be wrong, but I just given what I know about history and the industry itself, I don't spend a lot of time worrying about this issue.
Yeah, well, the only thing that has kind of changed for me a little bit now, it's still not a big fear and not a massive fear. First, in forms of inventory built up on NVIDIA. NVIDIA actually mentioned that I don't really see a massive inventory buildup in forms of a negative way. The company even mentioned that they're trying to ramp up production even faster than previously expected because they want to sell as many chips as they can right now. And that ramp up might be extremely costly, and that's where we kind of see a margin hit. So it seems like this company has plenty of demand and is just trying to sell as much as possible. But one thing with these now kind of going with these political concerns here in parts like China, one of my biggest concerns there is we're putting a lot of geopolitical export restriction laws into China, right? So eventually, if AI starts to evolve so quickly at massive levels, and we're not able to send chips over there, I wonder how China might react to say, hey, look, is there too much pressure having? So it's going to be a curious market to kind of follow through and see if we can put more export restrictions to China, if we actually start to see maybe some easing, because the pressure can increase more tensions between some of this TSMC risk.
Yeah, and we have to remember that DeepSeek made its breakthrough on some of NVIDIA's lower end chips too. So the technology hasn't necessarily stopped China. So it will be interesting to see what happens. But I don't spend a lot of time worrying about it, to be honest.
Yeah, I'm not losing sleep about it at all. I just probably maybe nowadays take an extra, when I get asked that question, maybe take an extra minute of thinking. That's the biggest change it has made.
Yeah, I think the scariest part too is it just takes so long to build a foundry, and foundry construction both in the U.S. and Europe is slowly ramping up, but it's still going to take several years before these Intel, Samsung, and TSMC foundries in TSMC's case outside of Taiwan, it's going to take a few years before those are operational. So as more become operational, that will take some of the pressure off. But yeah, it's still, I think it's until fewer chips relatively are made in Taiwan, I think people are still going to ask about it.
Yeah. Luckily, well, I mean, the one here in Arizona from TSMC is already producing some, but like for full production, is still, I think, a few years a few years away. But they are already producing some internal chips here in the Arizona plant. Um, well, I could take this question about 8 minutes ago from Vihan. So this is more just a general semiconductor question. So Jose mentioned semis are cyclical. What are a list of semi stocks currently at a low end of cycles position for a turnaround, and how do you manage cyclical cycles? Vihan, I think this is everybody's going to have their own ways of handling the cyclicality of the semiconductor space. For me, Will, I tend to try to understand where we are in the cycle. Obviously, I could be wrong by a quarter or two, maybe even three. But I try to at least understand, are we closer to the bottom or are we closer to the top? The best way to kind of look at that is, let's say I'm focusing in a semiconductor stock that's in the automotive space. I would like to take maybe a few minutes to listen what your Ford says about the automotive market, what your Tesla says about the automotive market, right? They can give us an indication early on if they're seeing some form of headwind or tailwind in the automotive space. So whatever segment you're thinking of looking into the semiconductor space, look at their end users. And they can give you some highlight of how the market is moving. Technically, Will, I like to purchase during the down cycles. For example, NVIDIA, my biggest kind of net positions were added in 2021 or 2022, around that time frame when the stock took a massive hit after the metaverse bubble bursted. So during that down cycle, because a lot of over inventory was purchased during that time. Now I'm not really purchasing or even adding much NVIDIA at these levels. Right now, I'm really excited about kind of the automotive industry. Well, I don't know where that's going or when it's going to turn around, but automotive chips can be used for things like robotics. Their power solutions can be used in things like AI servers. So when that turns around, I would expect maybe a nice return on stock prices. But the semiconductor market has so many spaces. The smartphone industry, I would say, is in the bottom and closer to seeing a turnaround story. The PC side, in forms of like CPUs, we're seeing PCs are still weak in sales, so it's closer to the bottom, but maybe we might see a turnaround. Consumer tech overall, I think it's in the bottom, it's in a down cycle. Automotive in a down cycle, telecommunication, everything is probably in a down cycle except AI accelerators. So I really am looking a lot in those industries and either buying or doing more research and waiting for that turnaround story. But that turnaround story can take multiple quarters, maybe sometimes even years before I see the real returns.
Yeah, I'm glad you brought that up because when I saw the question, it's like, okay, which part of the semiconductor industry are you talking about? Because there's so much going on. I'd actually, AMD fell below 100 today. I'm actually, maybe interested in buying some of that. Although I probably had to take some vacation because I'm not compliant, so I'm talking about it all the time now. But that one looks very interesting to me. I was, and like Jose mentioned, I was also thinking about the smartphone industry and Qualcomm. And yeah, Qualcomm is interesting now again because of the DeepSeek breakthrough. They've been trying to get an AI upgrade cycle going, but with that being more of a top end technology, I think that hasn't taken off to the degree that Qualcomm was hoping. That might change now that AI is becoming more democratized. I think time will tell on that one. But we'll just have to see. And speaking of smartphones, I was going to touch on this question from Sadaf that he asked a couple of minutes ago. Jensen keeps talking about AI in every device. Is NVIDIA involved in any smartphone chips? I don't really think they're into that. I mean, the dominant player forever has been Qualcomm. Apple has been trying for many years to break into this and replace Qualcomm in the iPhone. There's some indications that they may do it. There's some rumblings that they don't want to renew their agreement with Apple. So time will tell on that one. As far as I know, though, NVIDIA is not in that sector. I'll have Jose chime in to see if he corrects me. But I think NVIDIA is mostly focused in other areas.
Yeah, well, it doesn't. You're correct. They're not focused in the AI phone business. But I mean, if whatever type of AI will be coming to the phone will have to most likely be trained on some form of product, so NVIDIA can benefit out of that. And I mean, there have been some rumors that I've been hearing in the channels that I listen in the semiconductor space that NVIDIA can one way or another enter this market. And one way to do that, is actually licensing kind of their Tensor Core chips. And that's kind of like the AI brain. So one thing that NVIDIA could do is like, hey, look, we're not going to develop our own chip, but maybe we can license our IP, our software solutions. And if you are a cell phone maker, just pay us a nice either royalty fee or something, and you can implement our GPU, which is going to be great for any type of AI workload, maybe even any type of gaming, into your phone. And that's how NVIDIA can enter into the space. So if AI really enters into and this is what gets me excited about NVIDIA, right? While they might not be in the market, they can enter it pretty quickly via licensing deals or either kind of partnerships. We've seen them enter the CPU space for the consumer market, not necessarily the consumer market, but at least outside of the data center space with this partnership with MediaTek. They announced this pretty cool kind of developer PC. And because of that partnership, they're entering the CPU space and getting closer to the consumer space. So rumors are phasing, and there's always the optionality for them to enter in it.
Yeah, so it will be interesting to see what happens there. But as Jose pointed out, NVIDIA is probably going to be involved indirectly at least. But I don't think they intend to become a direct competitor of Qualcomm. I mean, Jose mentioned MediaTek. For those of you who don't know who they are, they're a competitor of Qualcomm based in Taiwan. Their chips typically aren't as advanced as Qualcomm's are, but on the lower end, they are a factor in the industry. So in that area, they tend to the bulk of their sales is focused on the lower end phones.
Yeah, so I mean, because they are competitive, you never know. Maybe they can again optionality. Qualcomm can partner up with NVIDIA to kind of create even another partnership to kind of enter into the phone business, just like they partner up with MediaTek for the PC business. So, but I agree, Will. I don't think they will ever directly enter it as, I don't think NVIDIA is chasing a low margin fruit. Whatever they enter has to be high margins for them because I don't think they want to dilute their margins too much.
Yeah.
Any question you see there, Will? If not, I'll take one so you can look for another that you may tackle.
Okay, go ahead. Yeah.
Pro Shop Guy, about 10 minutes ago, LLMs AI is a text video. LLMs AI is text and video product for the data world. Can AI move to the physical world, robots, self-driving, and cars? Yes, Pro Shop Guy, and I think that's what we're seeing right now. One of the things that AI is doing, it's creating intelligent data. So obviously we have a lot of data, but that data is not necessarily useful unless you have some form of engineer or data analysis or someone look at the data and decide what to do with it. But now with artificial intelligence, Will, you're able to move all this data from your computer or wherever and give it some form of thinking process. And that thinking process is AI. So now with all this data, and some simulations we have, you can now understand how the physical world works and translate it to the digital world. So that's what we're seeing kind of a lot of companies start to do simulation training for either the automotive market, for the robotics market, as now this simulation world has understand the laws of physics, and understanding the laws of physics allows the robot to act exactly how it would act in the physical world. So historically, Will, physical data and real data was a lot more important than synthetic data. But I think the shift is coming where synthetic data is going to be very crucial, not just for like typical LLMs, and video, but eventually to physical products like robotics and self-driving cars.
Yeah, I think that's much of the Tesla value proposition actually going forward. So yeah, it's definitely going to be a bigger factor in the physical world. So yeah, I'm going to attempt to take this question from Vihan. I don't know all the stocks that you're interested in, or at least I don't know them well enough to probably completely answer the question, but I'll attempt it. Gentlemen, which looks attractive in terms of valuation, gold, silver, bronze? COHR, I honestly don't know what that is. AVGO, which is Broadcom, TSM, Taiwan Semiconductor, MRVL, Marvell, KLAC. I should know that one, but I'm blanking on it. I don't follow that one very closely though. Qualcomm, GCOM, and AMD. So what? Out of those, well, I can address those based on the companies I know. I think it kind of depends on what kind of time frame we're talking about. I think Broadcom's very highly valued right now. I don't think I'm not pessimistic on it, but I think it's been run up quite a bit. Same thing with Taiwan Semiconductor on a relative basis. It doesn't tend to attract the kind of valuations that some of its clients attract, but it's been relatively high lately. In terms of bargain hunting, I'd probably put AMD and Qualcomm as 1 and 2. Qualcomm has been suffering for a while just because ever since the 5G upgrade cycle ran its course, it's been struggling with to gain revenue growth. I think it's starting to come back, but I think it still has a ways to go. AMD, they're finally on the comeback trail as well. AMD's, we had that question about where chip stocks are in the semiconductor cycle. AMD is kind of hard to figure out because about half the company is in data centers, so that's AI accelerators. So it's a lot of the company was at the top of the cycle, but you also had gaming and embedded segments that were struggling. So it's kind of half and half with AMD. So, but I would probably go AMD, Qualcomm, and Broadcom in this case. These are complete guesses. I could be wrong, but that's probably where I would go with these with this group of stocks. I think Jose probably has some viewpoints. I think he knows I don't know if he knows all of them, but I think he knows more than I do.
Well, I wouldn't say with all the stocks that you mentioned, I feel the exact same way. I don't know how I wouldn't rank them all. I would just give you like which my top 3 favorite. And it's going to be very similar to Will's, I think, in forms of valuation. And right, we're looking at this question was more in forms of attractive terms of valuations. AMD would make it on that list for sure. Qualcomm as well. I think most people see Qualcomm as just a phone business. And while it is just a phone business as of now, they have the optionality and opportunity to enter into these Internet of Things, which I believe AI can boost some sales in that space. And like Will mentioned, that this is a company that's doing a lot of local AI, so they can definitely benefit in that. Qualcomm also helps Meta platforms with augmented reality glasses and virtual reality glasses. Maybe they both won't take off, but maybe one of them will take off, and that could be a huge growth opportunity as well. So AMD, Qualcomm. I agree with Will that Broadcom and TSM might have been a little bit too overextended right now, or excited. So I wouldn't pick those two. Clack, Will, and you mentioned you didn't. It's a semiconductor equipment player. I don't know. I actually can't pick a third. Maybe I would say maybe Marvell. I think Marvell would be my heavy growth play in forms of valuation. Marvell is kind of Broadcom's little brother. Marvell helps Amazon make their own AI chips, and Amazon has mentioned that they're going to build a lot of AI chips. So, well, I think my top 3 on this list will be AMD, Qualcomm, and Marvell.
All right. So let's see. In that vein, Foolist asked about 31 minutes ago. Can you name the 3 top growth chip stocks for the next 3 to 5 years. So I guess it's kind of the same question, except you're not limited to a group of stocks. It's a good question. AMD and Qualcomm, I own them both. They're in my top picks in that industry. Yeah, I like it like Jose a minute ago. I'm trying to think of it. Well, yeah, actually, if we're looking 3 to 5 years out, I'd probably put NVIDIA at the top of that. I know I've said some negative things about NVIDIA, but those are feelings more in the near term than in the long term. I think if NVIDIA has a big downturn, I think it's going to shoot up much higher and achieve record highs again. So I think that's going to happen to NVIDIA. So I'm going to go NVIDIA, AMD, and Qualcomm in that case.
Yeah. Well, the great thing in the semiconductor space is just like any other sector, there's so many different companies. I mean, you still have in this space, you have many companies below $10 billion, right?
Yeah.
That can still grow. But obviously with the smaller company, you have higher reward potential, but you also have higher risk potential, as maybe they might be competing against some of these players. I don't know if I would put a list here. I think it would be more of a market. I think within the next 3-5 years, semiconductor stocks in the automotive space are going to grow dramatically because we are kind of in the bottom, and in 3 to 5 years, I expect that to at least turn around. And like I mentioned, we can kind of see the robotics also kind of play. And robotics doesn't have to be sci-fi humanoid robots. You also have a lot of robotics already in place in the industrial market, and AI can help boost that even more. So automotive plays would be ones that I think in the next 3 to 5 years can do really good in growth. The other would be semiconductor equipment players. We are seeing kind of this expansion of chip factories being built all over the world. And we're going to continue to see high demand for chips in the future. So I think we're going to see growth in equipment products within the next 3 to 5 years. So that would be the other market. And there's a lot of companies in the equipment space as well. The third, I don't know what would be the third market that I would be really excited about, but automotive and equipment players are in a down cycle completely right now. In the next 3 to 5 years, I think they will be a lot higher than they are right now.
Yeah. So this is more of a comment, but I'll address it quickly. About 10 hours ago, Folio, this is actually addressed to Timmy B, but Tim Byers, drop a pun on us. NVIDIA is quickly becoming a server company. Just process that for a minute. Well, I suppose that's true, but I think NVIDIA is so much more than that. NVIDIA, of course, NVIDIA dominates in AI accelerators, but it's in gaming, it's in robotics, and it's in many other things. So I would recommend people look at NVIDIA as something more multifaceted than just a server company, or even just as an AI accelerator company. Even though that seems to be their dominant revenue source right now. They still do other things, believe it or not.
Yeah, well, and I feel like the story for a lot of these companies always changed just depending on the market. I mean, NVIDIA at the beginning was a gaming company. Then you would say it was a software company. Now you would say it's a data center company. And we see this throughout the whole semiconductor space. Right before you would say that maybe AMD was just a pure CPU play, and it's just the way the market evolves. I think as technology continues to innovate, you're going to see these semiconductor companies become the new blah 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 insert new technology here. So right now, one of the new technologies, even though we feel like data centers have been here for a long time, well, they really haven't. I feel like data centers are about 10 to 15 years at most, which in the big picture, that's nothing. So and then eventually, if we do kind of get into the robotics market or the augmented reality market, we're going to start to see some of these players become robotics or augmented reality companies in the future.
Yeah. So looks like Tim Jungles just asked another question about NVIDIA. he asked, do you add NVIDIA when it levels off? I think that depends on what you mean by leveling off. I'm not. It's kind of hard to tell what NVIDIA is going to do. Like I said, I was a little bit more bearish in the near term, but it seems like my colleagues, or at least most of them, seem to disagree with that. So if it did level, it would depend on where it leveled off for me. If it has the 50+% drop, and I don't think it would really level off if it fell that much. But I'd probably be a buyer there. If it levels off around where it is, I'm probably not going to be a buyer for a while, if ever.
And yeah, I mean, I don't know. Like I mentioned, I'm bullish in NVIDIA on long term. But I wouldn't be buying at these levels. I mentioned I'm more of a purchaser in down cycles. Times like this where the stock is at 120, it's more of just like maybe small nibbles here or there. But it's not anything that I would go, hey, load up the truck. In my position. And I think it's all dependent, right, Will? Because everybody has different exposure into different companies. Some might have 0% exposure. I have, I want to say closer to 25 to 30 on NVIDIA that I get to be patient. I don't need to add on every single little dip. I can wait for when I really find it pretty attractive. So it's all about portfolio management, risk to reward allocations, and all that is personal investment styles.
Yeah, as other hosts have mentioned before, we can't really give personalized advice. So, whether to add or not is going to depend on your personal situation. But yeah, at this level, personally, in my opinion, I would be adding either little or none at all.
Vian just came in with the question here. Will, gentlemen, ARM appears to be silently running away. Was better valued at time of NVIDIA acquisition. Current valuation of ARM, would you consider building a position? I mean, this stock, NVIDIA was expected to buy them a few years ago, Will, at about a $40 billion valuation, I think. I think it was $40 billion. I think now the stock is trading north of 100 billion, just looking at numbers. 140, about 137, so closer to 140. So over 3x what NVIDIA was going to acquire for them just a few years ago. I definitely see the opportunity of ARM, Will. For those that are not familiar, ARM, ticker ARM, license creates a form of brain. I think this is probably the easiest way. They create a brain that you can kind of license and create semiconductor processors out of it. So a lot of big tech players are designing their own CPU. NVIDIA, which we've talked about, they have a CPU called Grace CPU, and it's designed based on ARM's brain. Amazon has a CPU that they've created called the Graviton, which is designed on ARM's brain. You have Qualcomm that designs processors for the phone industry. Those processors are made for using ARM's brain. So you can see there's this mass growth opportunity here. I believe any form of robotics brain in the future is also going to be using ARM's style of brain. But even with that, the current valuation, I'm not too excited about it, Will. I'm going to see if I can pull up real quick their PE ratios. And this is definitely one of the, let's see, let me present really quick, share screen, window. So ARM's PE ratio right now, Will, and hopefully eventually it pops up, is 171 on current PE ratios. Forward, which is the end of this coming fiscal year, is 81. Forward 1 year, which is the end of next fiscal year, Will, so it's a long time from now, is 64. So I think the valuation is definitely pretty ahead of itself. And the other thing that worries me about ARM is SoftBank, Will, owns a good portion of this company. I think they own about 80+% of the shares, maybe a little bit higher. I think it's closer to 90. And SoftBank recently has made discussions that they're going to invest dramatically in AI, One of those massive investments is Stargate. They've also have been reports that they're going to invest $20 billion on OpenAI in forms of monetary value. And the only way that I can see them building up a cash position like this is by selling some of their ARM shares. And if they sell some of those ARM shares, them being a major holder of it, it can cause a lot of volatility. And that volatility is not something I'm looking to hold. I'm not looking to make SoftBank richer as they try to sell some shares. Muted, Will.
So, thank you. Yeah, just I agree with Jose here. Looking at the price to sales ratio is 37, and then the forward PS ratio is 34. So again, I think that confirms what the PE ratio is telling you. The price is well ahead of itself. You talked about NVIDIA's attempt to buy them. And imagine how dominant, Jose, this company, NVIDIA would be had they bought them. I think Qualcomm and others put some political pressure on them and got that ended. But yeah, I think ARM is standing strong on its own. I agree with Jose here. I think it's overvalued here. But if there's a pullback, I would consider it. So it's something investors should keep on their watch list. But I think here you should just watch it rather than buy it.
Yeah, well, I think in whatever multiverse there is out there where this acquisition went through for NVIDIA, I think in that multi-universe, NVIDIA becomes the first $10 trillion company. I think if they would have acquired ARM, it would have opened up so many opportunities for them, and they would kind of create a pure monopoly in the robotic space, in the automotive space. So it made sense why the acquisition didn't go through. I completely agree, where it would have destroyed a lot of competitive pressure. So I'm happy it didn't go through. But in whatever world it did go through, NVIDIA investors are definitely pretty happy.
Yeah, and they're pretty NVIDIA is very dominant as it is with AI accelerators. So it's not like they missed out on any dominance. But yeah, I think that would have really upended the industry and created essentially an NVIDIA monopoly had that gone through.
And go ahead, Will.
Oh, I think you got a question from Vihan about NVIDIA. Since we're on the topic.
Yeah, so Jose noted that NVIDIA grew to a big position of your sleep, my overall portfolio. And what's my sleep number? If there is a sudden sell-off, your position drops 40%. Are you at peace, or will you think you should have taken profits? And I think that's when you know what your sleep number is. My sleep number is very different. For those that are not familiar, the sleep number is that number of what can that position be in my overall portfolio before I stop losing sleep. So like, let's say NVIDIA was 50% of my portfolio, maybe I wouldn't be able to sleep the night before earnings. What it is right now, it's probably very big compared to some others, but I do consider that I'm able to sleep. And I understand that if the stock drops dramatically, which it can, my portfolio will take a massive hit. But I think the sleep number is the number that you understand. If the stock drops, I'm okay that I took that risk. And like I mentioned, for me, I am I don't know if it's biased, but because I was able to enter at a very, very low cost basis, even if it drops, I still have made great returns from this stock. And again, I still also believe that in the long term, there's this opportunity for NVIDIA to grow. Will, like you mentioned, I mean, I don't know if it was you or with Danny a few hours ago, NVIDIA has seen over 50% drops over time. And we just seen one in the past 3 years, I think. Yeah. And I would be foolish to think, and not the good foolish, the bad foolish. I would be bad foolish to think that it can't happen again. So for me, that is my sleep number. But there's also what I only can have a position that big for a company I follow as closely as I do. I feel like if maybe I didn't follow NVIDIA as closely as I do, 30% would definitely not be the type of position I would want to have.
Yeah, and just investing in general. If you have a stock that's grown as much as NVIDIA has, you're going to have 50% drops and probably multiple 50% drops. And, every Magnificent Seven stock has seen several drops. I think at one point Amazon dropped 94%. Back in the .com buzz. So that these big drops do happen. So you need to keep that in mind if you're an investor. And we had a question a little earlier about semiconductor cycles and what I do about them. The truth is, I watch the semiconductor cycles, but I don't sell a semiconductor stock just because it's in a down cycle. And I'm thinking right now of AMD, which I think it got it almost to 230 last March. It was somewhere around there, and like I said, it fell below 100 today. I have followed that all the way down. I still am making a profit in my AMD investments because I bought them in 2022. But I will admit it gets a little nerve wracking because I had that decent profit at one point less than a year ago, and that now it's been nearly wiped out. So I'm dealing with a little pain on that one. But I know eventually. Like I said, semiconductors are cyclical. There's down cycles, but there's almost always an up cycle after that. So that's what I'm counting on. So despite my pain with AMD right now, I'm going to keep it. I may even buy some more. Like I said, if I can keep my mouth shut about it for a few days.
Yeah, and Will, I think that's very crucial to understand about the semiconductor space is that this is cyclicality. So if you see it down, you have to understand that you have to see the down cycle. Is this something just impacting the one stock or the whole or every stock in that segment? And most of the time, it's every stock in that segment. So that necessarily isn't a bearish thing. And Will, I think you mentioned it perfectly. I'm not here trying to sell the top of the cycle. Just because I think eventually these stocks will go back up as there will be another bullish cycle in the long term of things. And again, it's all about everybody's own personal investment style. Maybe because I'm still very early on in this, I'm able to ride out the cycles and I'm not too worried about them. The money I put in my portfolio is not money I need anytime soon. Obviously, if maybe you're closer to retirement, a semiconductor cycle could be a lot scarier, right? Because it could definitely impact. The other thing that I kind of look like in the cycle, Will, is I would only want to, if I believe we're closer to the top than to the bottom, because we're closer to the top, I'm going to guess eventually we're going to have a down cycle. So I would only want to buy companies that I believe have strong balance sheets, very low debt and very high cash, because during a down cycle, Will, those that are and just like any other stock, when we kind of see kind of either recessions or anything, those stocks that have the strong balance sheet, that have a lot of cash, that have no debt, are going to be able to make less, are going to be more relaxed. Obviously, it's not as relaxed, but at least more relaxed than a company that has high debt and low cash. Well, right now, when we are kind of in a peak cycle in the AI space, not peak, but closer to the top, I would only be looking at companies with very, very healthy balance sheets.
Yeah, and another point here is in the down cycle, you have to look at the stock as being on sale. I as I said with AMD, I know it's painful to see that big drop, but that's really creates a buyer's market in the stock. And like I mentioned earlier, if it has a down cycle, it's probably going to have an up cycle again. And I think if you buy in these down cycles, you'll be glad you bought when the cycle turns higher. Now there are some exceptions to that, like Intel in recent years, but as long as the stock is staying on top of things technically, I don't think you have to worry about what happened to Intel. And if you need some advice on that, well, we're here for you.
Definitely will. Tim Junglos just made a comment. He says, I guess it meant like the just everybody has their own personal experience, and that comes with time in the market, right? So I think usually if you're earlier in the market, you might be a little bit more impatient than maybe someone who's been in the market a lot longer. I remember, Will, when I first started investing, if I didn't see my stock go up every month or every week or so, I'd be like, hey, this is a bad investment. Now I can honestly say, Will, I don't mind if my stock barely moves for a year, maybe even longer, as long as my thesis is still intact, and I think the market would eventually figure it out. So I think definitely experience plays a lot in an overall investing mindset.
Absolutely. And yeah, you if you do this long enough, you will learn from some of your mistakes the hard way. That's a very painful way to learn, but I also think that's the best way. So you know, if you get a little pessimistic, I think the best thing is to get back in the saddle. Now, obviously, you don't want to make any rash decisions. I think you want to learn from your mistakes and learn how to learn better how to analyze. Learn your emotions too, because your emotions are probably going to tell you to buy high and sell low. And I think we all deal with that. So I think you like Jose said a minute ago, you really just need to stick with that investment thesis and hold to the investment thesis. Like you're hanging off handlebars. I guess that's trying to think of a good analogy for that. But yeah, hold on for dear life to that investment thesis, even though it might be painful to do that for a while.
Well, this is another interesting question here coming in from Vihan. And Vihan, appreciate the questions. If not, Will and I would just be talking to each other. So appreciate this. Vihan, Will or Jose, what are companies you wish you had in your portfolio and ran away? You don't, and now that even though they might be at a premium, you don't mind building a position now. Well, I don't. Again, I think this comes with experience. I feel like nowadays I don't mind missing out on a company, even if it's doing amazing. There's this saying that one train leaves, eventually another train is gonna come. And it's I I might have missed one cycle or another cycle, but 2-3 years from now, I think we're gonna have some new cycle that we can all benefit. So I'm not. I feel like I might have weakness, but I can't think of one right now that I would try to buy just because I missed it. Any that come to your mind, Will, that you would buy right now, even though you might have missed it earlier on? And you're paying at a premium. That's more important. At paying at a premium, at a huge premium today.
Yeah. I mean, I feel like I missed out on NVIDIA. I should have bought that in 2022 instead of AMD and Qualcomm. So, but you always have those. You're always going to have some of those regrets. But there are almost 10,000 stocks trading right now. So if you missed out on one, there's always going to be other opportunities. There's always new stocks coming on. There's always other stocks that are in decline, and some of those go away. But the market just produces so much opportunity. So if you miss out on one, just let it go and look for the next opportunity. You don't have to. It's always a mistake to get attached to one stock, because there's so many out there, and as I said, so many. There's always new technologies coming up that's going to lead to new companies, new IPOs, and I think eventually you'll find one you like if you missed out on it. So don't worry about your past mistakes. Don't worry about the stocks you missed. Just look for opportunities in the future and keep your mind there.
And well, before we end the show, I'm curious: is there any market that you're very excited about right now, or within either being in the tech? I know we're talking about semiconductors, but anything outside? I really enjoy doing these shows, Will, because I get to see what's outside the semiconductor market. I really have my head in the semiconductor sand, and that's usually where I focus. So, is there any markets that have you pretty excited for the next year or two, or that you're really kind of trying to do some more research on?
We've had a very high market lately, so I haven't been really. I mean, I don't think it's certainly not in the semiconductor industry, although I like the chip industry. I think he did the right thing by focusing on the chip industry. Actually, I look more for I look for more opportunities in individual stocks than I do new industries per se, because sometimes I'm wrong about where these industries are going to go. Sometimes I'm wrong about the stocks I picked within the industry. So as for the next year, I'm not really focused on industry. At least I think will do well in the next year. I'm looking at quantum a little bit, because like I said, I think that's a solution without a problem right now. But once they find some problems to solve, I think that one could really take off. But I'm not seeing it. either I'm seeing things I've missed, or I'm seeing things that are that may take a few years to pan out.
Thank you for that, Will. And this is now the end of our time, Will. So appreciate it, Will. And thanks to all the fools watching. Thanks to everybody on the back. And Fool24 will be back tomorrow morning at 8 o'clock.
On to really anything related to financial planning that you want to talk about. Could be retirement, could be saving for college, could be insurance, asset allocation. Oh, I don't know, taxes, estate planning. It is tax season after all. Dan and I will be very happy to answer your questions. But we're both former financial planners. I still have the certified financial planner designation. Dan is also a former attorney. So get those questions into Slido. If you don't see Slido, maybe scroll down on your screen, depending on how your screen layout is. You might have to scroll down to see it, or just go to slido.com and enter the code Fool24. We will answer your questions. As questions come in, talk about a few things on our minds. I'll just highlight that we are now almost at the end of February, so we are already about 1/6 through 2025. And at the end of the month, I always take a look back and see how things are going. I'm just going to provide a few observations. It's been a slow-ish year for most U.S. stocks. The S&P 500 is up about 1.5%. Really, that's not bad for 2 months' work. Certainly slow, less than what we've experienced in the previous 2 years, but not too bad. But in previous shows, as I pointed out, international stocks are doing quite better. As of last night's close, they're up about 7% so far this year, although they're down today because of concerns about tariffs. President Trump has said the tariffs will go ahead with for Mexico and Canada, but then also Europe as well. So they're down a bit. But perhaps what might be most interesting is that so far, the U.S. bond market is outperforming the U.S. stock market. The Vanguard Total Bond Market ETF is up about 2.5% this year, which is nice to see because bonds really have been on a pretty lousy run for really about 5 years. In some ways, the worst stretch for U.S. bonds ever. And why are bonds up? Well, because interest rates are down, and particularly interest rates for treasuries that mature in 3 to 6 months or longer. Short-term treasuries are kind of holding their ground, but treasuries like the 10-year treasury, 30-year treasury, they have come down, particularly over the last 2 weeks. So you've seen a nice jump in bond prices. And in fact, the yield on the 10-year treasury is about the same, if not a little bit lower than the 3-month treasury. And what that means is the yield curve has inverted again. So this has traditionally been a very good predictor of a recession at some point. Doesn't mean a recession is right around the corner. Sometimes it takes anywhere from 6, 12, even 18 months. And sometimes it gives a false reading, such as the last time it inverted, which is in, I think, around 2022. So we didn't technically have a recession, but we definitely had a slowdown in the economy. So that's the thing that is attracting my most attention for me the most. Whether or not, we get an official designation as a recession at some point from the NBER, which is the group that gives us such things, I think it's an indication that the economy could be slowing down. We already see that in other ways. For example, layoffs, not just the government, but in some corporations as well. So that's just an observation, something I think to factor into your own decisions about your financial planning as well as your portfolio. But with that, I will turn it over to Dan. Dan, what's on your mind these days?
I'll just build on that just a little bit because it's been troubling me too. Whenever you get news of layoffs, both in the private sector and in the public sector, you start thinking about what the second order domino effects are going to be on the economy. Especially, I was reading an article in the San Francisco Chronicle about layoffs in the San Francisco area, as so many of those jobs are, if they're not being eliminated, they're being moved. Texas has been a high-profile destination for companies seeking to leave California, but it's not the only one. You're seeing a ton of interest in the southeastern United States as well. And so, questions come up about, is the pay the same? If the pay is not the same, is this cost of living different? All these things, it's something that plays into, then you start following the ripples out. And so you look at housing market issues, you look at, strong US dollar, the impact that has on foreign interest in purchasing real estate in the U.S. Still have a pretty tight housing market in terms of not many people are clinging to those low interest mortgages that they were able to get before interest rates went up. And so until they are forced to move, a lot of people are hesitant to do so, because getting a new mortgage these days, 6%, 7%, is not like the 3%, 4% mortgages that they had in the past. And so, the other thing just to pay attention to is, the trends in technology towards making companies more efficient. That is great for us as shareholders, as investors, not necessarily as good for the employee base. And then the question becomes, okay, if all of those former employed people are out of work, where are they going to get money to spend on the things that drive the economy? And if they no longer have money to spend on the things that drive the economy, then you start to get into what Bro was just saying about maybe you do start to get some recessionary concerns. But it's one of those things that, you have to assess the impact in your area. Many of the federal government cuts that have made headlines lately, a lot of people focus on Washington, but I'll tell you, there's a lot of small towns where the federal government is a major contributor to the economy. There are large parts of the country where the federal government has a lot to do with the economic sustainability of things. And so, it's an experiment. I guess we're just going to see what happens as far as, when there are cuts, what are those people going to end up doing? What impact is that going to have? If the government is successful in finding ways to kind of reposition those folks, then it'll be a win. If those folks end up struggling and not being successful in finding alternative work, then maybe not so much. But we will see what happens from that. I wanted to touch on something. I was talking to my buddy Sina Hasuna. You guys know him as Sina NYC. Often will ask questions here on Fool24. And let me pause for a minute and just urge all of you, please do ask us some questions here on Fool24. Really just about anything. I mean, we've got individual stock questions that we prefer not to handle because we are not individual stock analysts for the most part. But just about anything else with your financial planning, with your estate planning, with your tax planning. Can't give you individualized formal advice. Nothing that we give you should be taken as personal financial advice, but it is something that can point you in the right direction, kind of give you a gut check, maybe you hear something in the thoughts that we talk about that raises your eyebrow and say, oh yeah, I didn't think about that. That may be something that you can then take to an attorney or an accountant or a financial advisor, whoever you have on your team helping you in your individual situation. So do please get those questions in. But with Sina, I was talking recently. Sina just recently did a consultation with a certified financial planner, and he was nice enough to share the experience, kind of talked through things. And one comment that he made was that he was kind of surprised when he got the deliverable, when he got the report back from the CFP. It wasn't really as detailed as I think that he was expecting it to be. Kind of more emphasizing on a big picture scale, less so on very specific guidance for, sell this, exchange this, maybe take care of this. There was some of that, but I'll tell you, getting a financial planner, finding the right financial planner for you, there is an element of you need to find a relationship. You need to find something that will work for you. And different CFPs, they all have fiduciary duties to you, but the way that they execute those fiduciary duties can be different. Some CFPs, some financial planners will be highly quantitative. They will be happy to run everything through mathematical models. The firm that you might work through might have Monte Carlo simulations to kind of go through a whole mess of different possible future scenarios to try to stress test whether your financial plan will actually work in the worst case scenarios and the best case scenarios, kind of giving you a sense of how much leeway you have, how much flexibility you will have in any given plan. Some financial planners really love that. Other financial planners are less into the quantitative side and are more about relationships. They're more about making sure that people are comfortable with the general idea of investing, less so on, individual stock A versus individual stock B. And that can be something that really appeals to people who are intimidated by stock investing, who are intimidated by trying to do financial planning for themselves. the last thing that someone who doesn't know very much about financial planning, who's very reluctant even to get into it, the last thing that person needs to see is a detailed spreadsheet, because that assumes knowledge that is not in fact there yet. And so that person might prefer to have a certified financial planner who doesn't give as many details, but who can provide the confidence and assurance that there is a path forward and that the person will be able to help their client get through that. And so there is no, what's right for you might not be right for somebody else, but there's no wrong answer in general. There are plenty of people out there, but one thing that you can do so that you're not surprised is ask, when you have that first consultation, before you start getting in the nitty-gritty about what your financial assets are, what what your job is, how much your job pays, what your family situation is, what your expenses look like, what your financial goals, what your financial plans are. Before you get into any of that, a perfectly reasonable ask to make is to ask that financial planner, can you give me a sample of a report that you did for another client? Or maybe, they're not going to give you information on the other client. They're going to black out the names, or they're going to take out the names or redact it, whatever they need to do. But to get a sense of what you're going to see at the end of the day, most financial planners, they come up with a strategy for how they make presentations to their clients. And for the most part, they follow them. Now, if you feel very strongly that you want something in particular in a presentation, most financial planners will be flexible enough to give it to you. But in the absence of specific direction, most financial planners have a comfort zone where they've worked with all kinds of clients and they know what works. And so they work the stuff that works into the report that they give. When you see that report, that sample report, that's your opportunity to say, oh yeah, this looks exactly like what I need. I'm looking forward to this. Or, you know what, this looks pretty good, except I'm going to need some more information about this. And then when you have that consultation with a financial planner, you can point that out. You can say, hey, can you give me more detail on this? Because I'll tell you, if I got this sample report, I wouldn't really know what to do. I wouldn't have enough information to go on. And so that is something to consider. And then finally, if the report just looks like total gibberish to you, you don't understand it, maybe it's got a whole bunch of spreadsheets in it and you're not really ready for the spreadsheet for you, or you've done your own spreadsheet and you just don't really agree with the format that they're going for, then go find yourself another candidate. And that's a good way to weed out what could potentially be a disappointing relationship, because nobody likes to spend money on a financial consultation and then not get what they paid for, not get what they expect. So I'll leave it at that. Please do share your experiences with financial planning, with guidance that you've gotten. And the same can be true for, attorneys or accountants, things like that. Just about anything that you're talking through, just kind of getting a sense of where those mismatched expectations can be and maybe what you've done to match them up so that you can strengthen that professional relationship. Or if you just decide to go your separate ways, that is always an option as well. All right, that's all I've got, bro. I'm going to look over questions and see if we got any questions coming in.
I'll go ahead and answer one and really sort of two of the questions, but feel free to get more questions in, folks. And this question comes from Let It Ride. There are a lot of choices for retirement calculators out there. Which one do you like? And I will try to get the link into Slido at some point, but it's from CalcXML. CalcXML has several retirement calculators, at least a few. So you're looking for the one that has 606 at the end of it. And you're right that there are a lot out there. And there actually been some studies that showed that a lot of them are actually pretty bad. So if I may, I'm going to try to share my screen and just go through the calculator very quickly to demonstrate what I like about it. But just so you know what I think is a good thing to have in a retirement calculator, so that when you look at other ones out there, you know what to look for. So here it is. It's not very fancy looking, very simple. You got the URL up the top. One thing I like about it is that it breaks up the spending in retirement into 3 stages: early, middle, remainder, or what some people call the go-go years, the slow-go years, and the no-go years, because research indicates that actually retirement spending does not go up every year along with inflation. Kind of it's a little bit behind inflation, 1% to 2%, and sometimes even goes down, right? Especially if you're entering like a retirement as a married couple and then one passes away, or you enter retirement with a mortgage and the mortgage gets paid off. So that's one thing I like about this. The other thing I like about this is that you list all your different assets, but then you can choose whether it's traditional Roth or taxable brokerage account, because not every retirement calculator will distinguish between the tax status of your accounts, which, is a pretty big deal, whether the money coming out of your account is being taxed as ordinary income, like a traditional account, tax-free is in a Roth, or a mix of, income, I would say interest, dividends, capital gains, and a taxable account. So that's another reason why I like it. There's lots of other details here that I won't go into. You can choose to include Social Security or not, and the tool will calculate Social Security for you based on what you enter at the top as your salary. But that's probably just an estimate. You should use your own actual projected benefit, which you can get by creating your My Social Security account at the Social Security website. But then you can choose to ignore Social Security if you want, or give yourself a haircut. We talked yesterday on the retirement show, or on the financial planning power hour, about how it might make sense to assume you're only going to get 75% of what you're projected, because the trust fund will be depleted in 2033. And then the other thing I like about it is here you can add other things, right? It could be maybe you're going to sell a business, you're going to sell your house, maybe you have a vacation home that you plan to sell, or an RV. There are other ways to enter other sources in here. Maybe you expect an inheritance. Of course, you don't know when you're going to get that inheritance, but you could factor that in. And then down here, it provides where you enter in the returns, and not every calculator will allow you to do that. Some calculators put in the return. This way, you can determine your own returns. They're pretty conservative, and even has a little pop-up there that shows you what historical returns, at least since 2023. And then also tax brackets are up here. But again, these are 2024 tax brackets. So I think that's all very handy. So those are the things I would consider if you're looking for a tool. And I'm going to stop sharing now. And then there was another question about whether there's something that will, if I want to get the words correctly here. Let's see, it was about retirement income. Where did that one go? Did it go away?
It might have gone away because it looked a lot like the one question that you did end up answering.
Got it. So okay, this one was specifically, this one was specifically about retirement income. And there are some calculators, Vanguard, for example, that will help you go through your projected expenses and sort of calculate them. I'll see if I can find that link as well. But that's something else to consider.
All right. I'm up. I'm not muted. That's good. 9 minutes ago, Let It Ride asked. No, this one was 11 minutes ago. Good morning. Do you think that it is better to buy or to rent? So I'm going to assume probably you mean a home, although it's interesting. Advice that I recently gave my daughter was basically if you have to buy something, if you can't pay for something all upfront, then don't buy it. Now, that's not going to apply for things like housing, but it does apply to some extent for issues like clothing, like, for necessities, for food, for going out for a restaurant, for even like a car, although she's not in a position where she's had to purchase her own car as of yet. But the philosophy is pretty simple. If you can't afford to buy something, then the question becomes, are you overextending by coming up with another way of doing it? Now, this doesn't necessarily apply as much to the housing question, because housing's a little bit different. And the reason housing is a little bit different is that having a home has both financial and non-financial consequences, both economically and things that you have to deal with. For instance, say that someone was going to move to a new city and they knew that they were going to be there for 6 months exactly, and that job was going to end, or whatever their motivation for going there was going to end in 6 months, and they would return back to their home. And the question would be, well, do you buy a house there or do you rent a house there? A lot of people, I think, would choose to rent because there's some time and hassle commitments that you have to deal with when you buy a home. You have to go shop for a home. You have to haggle on the price. You have to have the home inspected. You have to make sure that it is going to meet your needs, that there aren't any nasty surprises lurking in the attic somewhere. You have to get mortgage financing. You have to find a lender that's willing to loan you the amount that you're going to get. You have to pay closing costs. Then you're there, 6 months pass, you decide you're going to go back because the reason that you were there ended. So then if you bought a home, you'd have the same process to go through. You have to find yourself a real estate agent to sell your home. You have to deal with the buyer wanting to do all that whole process of getting the home inspected and haggling through with the price and trying to figure out financing. Maybe you get an offer, but the offer falls through because they can't get the mortgage that they'd expected to get. It can be a long and devastating process. And so a lot of people for 6 months would say, you know what, I'm not going to deal with that. I'm just going to rent a place. Yeah, sure. Maybe it's not going to be the place of my dreams, but it's only for 6 months. When you extend the time horizon, I think things get a little bit more complicated, but then you have to start to focus more. There is more of an economic element to it. As far as pros of owning a home, when you purchase a home, you enjoy, if you are in a market where real estate prices will generally trend up, then you will enjoy the benefit of that appreciation. And that's one reason why my example kind of works the way that it does. In 6 months' time, it's very unlikely that your home's value is going to appreciate very much. And in fact, it may be, you'd be lucky if it appreciated enough that you'd be able to cover 2 sets of closing costs, essentially, and cover those, and still make a profit on it. Over a longer period of time, though, 5 years, 10 years, 20 years, you can often see a big increase in the value of a home. And when you're renting, you're not the one who gets that. Instead, generally, you're the one making monthly payments, and oftentimes those monthly payments will be going up over time. And so from year in, year out, you may pay a little bit more for your rent. And at the end of the day, you're not the one, if there's an increase in the value of the property, you're not the one who benefits from it. Whoever your landlord is going to benefit from that. The upsides of renting, on the other hand, are generally, they're the hassle factor and the economic factor of having to deal with maintenance, having to deal with unexpected repair issues, things like that. When you rent a place, oftentimes you can just go to your landlord and say, hey, the pipes burst. Hey, the paint is flaking off of the wall. Hey, it looks like maybe there's a leak in the roof. And that's all you have to do. And you're not the one who has to figure it out. You're not the one who has to find a contractor in today's busy world where it is next to impossible to find people to provide help with those kinds of jobs in many places. You're not the one who has to figure out what the best way to deal with it is. Now, different people are going to weigh those pros and cons differently. If you're good at doing your own home maintenance, for example, then you might be much more comfortable owning. If you are really bad at dealing with that maintenance stuff and you just don't, the idea of maintaining your lawn and planting a garden and things like that, it is not the appeal to you, then you may end up not wanting to buy and instead hand that responsibility off to whoever you are renting from. So those, I could keep going, but I'm not going to. Bro, I'm curious if you feel like weighing in at all on the buy versus rent question. I know you kind of come from a different perspective because you are in a market where home prices for purchase have gone up quite a bit. I don't actually know what in the greater DC area the rental picture looks like, if rents have increased just as much or if rents are reasonably affordable compared to purchasing a home. If you don't mind, tell me a little bit more about that and how that plays into how you would suggest to somebody in your area how to approach that buy versus rent question.
The honest answer to that question is because I live in the DC area, which is home to 20% of the federal workforce. I would say hold off on making any major decision related to buying or renting right now. So that's my honest opinion about it. I was just walking around our neighborhood last night. I mean, our neighborhood is full of government employees, government contractors. Mark Esper, Donald Trump's first Secretary of Defense, lived in our neighborhood.
Yeah.
So it's going to be very interesting.
Have the for sale signs gone up yet, bro? Or
no,
yeah.
no, not yet, not
Okay.
yet. But really, it's going to be a very interesting year. I mean, I certainly know people who are very concerned about their jobs for sure. That said, getting back to the main question, I know you talked quite a bit, and I was doing a little bit of research, so I didn't hear everything you said. But I will emphasize one thing that you did say, and that it's partially a financial decision and partially a personal decision. I could go either way personally and living in a rented place or owning a house. My wife loves owning the house. She is by nature a homebody and someone who just loves to do things to the house. I would just say that in terms of the financial aspect, you have to appreciate all the costs of owning the home, which includes taxes, maintenance, insurance. Compare that to renting. And if renting is much cheaper, and make sure you're banking the difference, because with the house, you are building up home equity and you do have a certain amount of inflation protection because your mortgage is fixed and ideally the house will go up. And historically, houses go up at a rate of about 1% above inflation when you factor in all the costs. And that's according to research from David Blanchett, who was formerly of Morningstar. So hopefully that helps with that. I will go ahead and get one question here from Murali, hopefully I pronounced that correctly. What are your thoughts on index universal life insurance policies? Interesting question. So my thoughts are they're great in theory, but when you dig into the details, you factor in the costs and the illiquidity, they probably don't make much sense. So these are basically cash value life insurance policies. So they provide some life insurance, but also a cash value component. And the cash value is determined by the performance of a certain index. It's very frequently the Dow or the S&P 500. And what the selling point is, if the index goes up, you make money. If the index goes down, you don't lose any money, or you don't lose as much as the index. There's a floor to how much you will lose, so that sounds great, right? Except that you have to understand how they calculate the amount of the participation in the upside and the downside. So what often happens, first of all, is there's a cap. So it'll say you will earn 8%. You'll earn the return of the S&P 500 up to a cap of 8 or 9 or 10%. So last year, the S&P 500 was over 20. You didn't get that. The other thing, generally speaking, is that dividends aren't a part of it. So these days, with dividends relatively low, a little over 1%, that may not be as big of a deal. But know that is not part of it as well. And then you have to understand, are those returns before or after cost? And often they're after cost. And the costs of these policies are often a good 1%, 2%, 3% a year. And that you have to lock your money into these policies as well, right? So it's difficult to get the money out. And if you were doing this purely as insurance, like if you're really looking for insurance, then term is going to be much, much, much cheaper. Although at some point, you can't really get term; it's too expensive. So I'll hit here then into a couple of the pros of really any cash value life insurance policy, which would apply to this, right? You could keep this policy for as long as you live, as long as the premiums are being paid. So that's why it's often called a version of permanent life insurance. And it can be a resource in retirement and a tax-free resource because you're not taking the money out, you're borrowing the money. And like most loans, borrowing money from your life insurance policy is tax-free, which is great because that you don't pay taxes on it, but there are other things in your retirement that are determined by your gross income, such as the degree to which your Social Security is taxed, how much you pay for Medicare. And you don't have to necessarily pay the loan back. It depends on the policy, but you could just take out the loan, but then when you die, the amount of the outstanding loan, and there is interest associated, is just taken away out of the death benefit. So To sum up, I would say great in theory, but you really have to dig into the details on whether it makes sense and whether it's a good policy. And if the person who's trying to sell this to you started with something like 401ks are a scam, don't use a 401k, go into this type of life insurance policy, then run away, because you'll see that a lot, especially on TikTok and maybe YouTube. These are just salesmen, saleswomen trying to get you buy the life insurance policy. They really don't understand the benefits.
Yeah, I'll just second that. It's one of those things that the product, Bro is right that it's important to dig into the product, but what you will often find is it's really hard to dig into the product. Like, you might end up having a prospectus that's 150 pages long, and there's almost this calculus level math that goes into figuring out what the index, what happens if the index goes up a certain amount or goes down a certain amount, or if company pays a dividend a certain amount. I mean, I've looked at them, and it's tough. It's been tough. Even professionals who kind of understand this language and are versed in the ways that lawyers write prospectuses, even they have trouble figuring out exactly how some of these things work some of the time. And so, in my opinion, life is often too short, and you're better off, there's other ways to kind of protect your risk. For instance, one thing that a lot of people will get these things for is they don't want to lose money. And my view is that if there is a level of losses that you are comfortable with, then there's an asset allocation out there that can generally give you that kind of protection without a whole lot of bells and whistles, without the need for an insurance wrapper that you may not need. Now, as Bro points out, if you actually need the insurance, if the insurance is a valuable part of this, then that can change the calculus. But at the same time, there may be simpler ways to get the life insurance element as well. So that is definitely something to think about. Miss Melanie, 15 minutes ago, asked us, what are the pros and cons of transferring a primary residence into a trust? Does it impact the joint tenancy with rights of survivorship inheritance rules? So Miss Melanie, yes, it does. I'll answer the second question first. Yes, it does. You would not hold an asset if the asset is held by the trust. The trust will not have a joint tenancy right of survivorship. Whatever the trust says happens on the death of one of the people involved in the trust, it may be the only person involved in the trust. Whatever the trust instructions are, that is what the trustee will be required to follow when one of the, if you're talking about a spousal situation, which is usually what you're talking about with joint tenancy with rights of survivorship, then when one of the spouses passes away, you look to the trust, and the trust will say whatever happens to potentially that spouse's share. I mean, trust can be written up in any number of ways, but you can mimic the treatment of joint tenancy with rights of survivorship inside of a trust. It's just not going to be that type of titling. It's just going to be in the name of the trust. So more broadly, the pros of transferring a primary residence into a trust are generally the same as, the benefits of transferring any asset into a trust. Not subject to probate generally in the event of a person's death, of an owner's death. Not subject to the the public disclosure rules that are often involved when an asset is part of an estate, and also it just kind of keeps things, keeping them outside of. Well, wait, now I'm getting mixed up here, aren't I? So let me back up for just a minute. So let me start over with the trust pros. The pros of the trust are anonymity in terms of disposition, and because it'll stay in the name of the trust, even if the beneficiary of the trust, the future beneficiary, takes over after the present beneficiary passes away. Inside of a trust, you would also potentially avoid the probate question. Now, for some of the negatives, you have to look to state law to make sure. There are some states where an individual or a couple who hold a home in their names sometimes with a specific or special form of ownership, will qualify for extra benefits, extra pros, things like maybe creditor protection. I know that in my state of Massachusetts, there's a homestead exemption. If you declare your primary residence to be eligible for the homestead exemption, that gives you certain protection from creditors that you wouldn't have absent having that exemption. So it's things like that. You might get a property tax break. And the question becomes, is the state going to be smart enough to realize, especially if this is a revocable trust where you are the person creating the trust, you are the beneficiary of the trust, and you are the person getting the enjoyment of living in the home. In that aspect, nothing has changed. But if the state doesn't, if the state still looks at it like, well, hey, there's a trust, it's not you, then that might remove your eligibility for some of those positives. And so that's something to think about as well. You're going to need to usually do a special type of real estate deed in order to convey the primary residence into trust. That may require some filing fees. That may require paying your attorney a little bit extra to prepare that real estate deed. Not a huge deal, but it may be enough to, sometimes you might find that it's a tiebreaker. But that's kind of a short view of the pros and cons of dealing with primary residence when you're putting it into a trust.
Steve D asks, have you seen any correlations between the average S&P 500 PE ratios and recessions? The average PE currently is much higher than it has been historically. I haven't seen anything on recessions. It's an interesting question. I was trying to do some quick Googling and I didn't find anything, but it's an interesting question. So I'll look into that later. If I find anything, I'll bring it up on a future Fool24 show. But what I do know is that there are correlations between valuations and the subsequent returns over 7 to 10 years. So not over the next year, not even the next 2 or 3 years. But there is no question that there is a very strong correlation. Well, I should say a moderate correlation between starting valuations and returns over the next decade or so. And we are in high valuations, right? Goldman Sachs got some attention earlier this year saying they predict that over the next decade, at least this part of Goldman Sachs, it's a big bank, a lot of people there. But they put out a report saying that, valuations for the S&P 500 are in the highest 7%. And they predict that on average, the S&P 500 will return 3% a year over the next decade. That is, pretty stark, not very exciting. And I have shared all kinds of different projections for different asset classes over the years from Wall Street. Many firms produce what they call their capital market assumptions, either toward the end of the year or the beginning of another year. Christine Benz of Morningstar does a great job of summarizing them every January, saying, well, this is what people are saying now. So really, ever since Fool Live began 5 years ago, I would present these and I'm just saying, this is what people are thinking. And every year, they pretty much said the same thing. U.S. stocks would underperform the rest of the world because U.S. stocks are so expensive. Small caps would outperform large caps because large caps have become so expensive. And value would outperform growth, mostly. There are some firms who had different opinions, but that was generally how it's been. And of course, ever since that, it's the complete opposite is what has happened, right? So I don't know. I will say I take valuation into consideration a little bit when I am rebalancing my portfolio every year. Maybe selling a little bit of what has done particularly well and become more expensive to buy some assets that are underweighted. And now that I am within a decade of retirement, I'm doing a little bit more rebalancing into cash and bonds. What I do pay attention to is something like I said at the very beginning of the podcast. Sorry, I also do the Motley Fool Money podcast, by the way. At Fool24, I do pay attention to things like the inverted yield curve, because it does indicate that the economy is slowing down. Does that mean I sell my stocks? Not necessarily. What it really means is, for me, as someone who has a job, is that it's my time to think of like battening down the hatches a little bit. Because for most people, the biggest risk in a recession is job security, right? If you are living off your portfolio, if you are retired, Ideally, you have at least the money you need in the next 5 years out of the stock market in cash and bonds, maybe even more if you are a more moderate to conservative investor. So ideally, you'll be able to ride out the storm. If you're not yet retired and your portfolio goes down, that's actually good news, because that means all future contributions to your IRA and 401k will go in at cheaper prices. For those who are working and relying on a paycheck, the biggest risk of a recession is income security. And we're seeing that now. Of course, a lot of what's happening has nothing to do with the recession. It has to do with other things going on. So that's why I've mentioned in other shows, I think it's a great time to use a tool to really evaluate your budget and see, are you spending money in ways that are really important to you? For ways that are maybe a little bit more frivolous, it might make sense to be building up a little bit more cash, building up your emergency fund.
I'll just say that I think if you'd gone back to 2015, you could probably find one of those predictions that Bro was saying. You know, at that point, we'd had 6 years of bull market after the 2009 lows, and it would have been a perfectly reasonable thing to say and to look at and to say, yep, U.S. stocks likely to underperform long-term averages over the next decade. International stocks likely to outperform. And, we all know that has not really been the case. So, prognostications, I mean, statistics will tell you that just because a prediction is wrong just because the prediction doesn't turn out the way that you expected it to, doesn't necessarily mean that the prediction was wrong. A lot of it has to do with the fact that people make predictions as though they are 100% probable to happen. And that's never the case. If somebody tells me that there's a certain percentage chance, yes, it becomes almost meaningless in the eyes of many, because essentially you always have an out. It's kind of like the famous 30% chance of rain in the afternoon. It's kind of like, well, help me out here. I mean, what does this mean? It means that somebody's going to get the rain, but it's probably not you unless you don't want it, in which case you'll get it. But so it's a tough business, the prognostication business. You just do the best that you can. Bhavesh Shah with a question 10 minutes ago. Is it true when kids receive taxable capital gain stock in a brokerage account and real estate as an inheritance, then the value is calculated as a stepped up value and therefore save on capital gains tax? Bhavesh, often it is indeed the case. If someone, say, if someone had assets in a taxable brokerage account and they pass away, and those assets are in their name, and so it would be includable in their estate. Estate taxes are such that you have to have a $14 million estate before you even really have to start thinking about whether you're going to owe estate tax. And so a lot of people have a tax, they have an estate and their assets are going to go through it, but they're never going to realize it because they're not going to owe estate tax because the current estate tax exemption is so high. But that's the rule that technically applies here, is if the assets are part of what would be your taxable estate for estate planning purposes, for purposes of federal estate tax, then they will be eligible for a step up in basis because it's a taxable brokerage account. And so as a result of that, the value of the assets that a child or any other beneficiary would get is going to be adjusted to whatever the fair market value of that asset was on the date of the original owner's death. What that does in practice is that if a person held a stock for 10 years, 20 years, something like that, and it's gone way up, and they pass away and it goes to an heir, that heir generally has very little capital gains tax because you're not looking back 5, 10, 20 years to what the value of that was back then. Instead, you're just looking back a few weeks or a few months to whenever the person passed away. In general, that's not necessarily going to be a big movement. And so as a result, the tax impact, if the child ends up selling it, the tax impact ends up being relatively minimized. And so that can be, that can be a really beneficial way of handling these things. Consider the contrasting situation where a person sells their stocks immediately before they pass away. then suddenly they have on their final after death tax return, they're going to have a big capital gain to pay. And depending on their tax bracket, that could be a whole lot more money than the next to nothing that an heir would have paid if that heir had just been allowed to inherit the asset rather than the person who passed away selling out immediately beforehand.
We still have about 13 minutes left to our retirement show, financial planning Q&A. So if you have a question, get that in. We'll probably have a chance to answer it. I'll just add something to what Dan said. We often get the question of, okay, I've retired. I have multiple types of accounts. I have a taxable brokerage. I have a traditional accounts. I have Roth accounts. Which should I tap first? And most studies indicate that you're better off tapping the taxable brokerage account first and then going into the tax advantage retirement accounts. But that order reverses itself as you get older and you have stocks or whatever in your taxable brokerage account, and you know they're going to go to your kids. At that point, you probably should leave them alone, depending on your situation and the investment merit and all that stuff, of course, because by leaving them to your kids, you'll have avoided having to pay all those capital gains. All right, a question here is, what is the best way to hold cash? The answer is very tightly. No, I'm just kidding. I'm going to assume your question is about where to find the best yielding cash. But if it is more about which account, please let me know. These days, if you just go to your regular old bank, you're probably going to get maybe 1% on a savings account, maybe, and nothing on checking. But if you put in more effort, look beyond your regular bank or ask your regular bank what are the better options, you should be able to get something over 3%, if not 4%. The Motley Fool has a website called Motley Fool Money, which highlights higher yielding savings accounts, higher yielding CDs. These days, also money market funds are still generally yielding over 4%. I will highlight the difference between a bank account, like a savings account, and a CD, which is FDIC insured, as our money market accounts. Money market funds are not FDIC insured. So there is technically a little bit more risk with them. Historically, there's only been a couple that have had issues, but it is still a possibility. So if you're looking for FDIC insurance, stick with something from the bank up to the certain limits. And the FDIC does have a tool, actually, that will help you analyze whether your savings accounts are covered by enough FDIC insurance. It's their EDI tool. EDI stands for Electronic Deposit Insurance Estimator, I think. You could do an online search for that and find it. And the other thing I'll say, too, it's the same with your brokerage accounts. The default cash option in many brokerage accounts are ridiculously low. So don't let the cash just sit there. Look for a high yielding option if it's available. Just know if that you are choosing something like, a treasury ETF, for example, like SGOV, SGOV, which is a very popular short-term treasury bill ETF, one that I personally own, has a yield over 4%. Just know that if it's not exactly the same as cash, right? Because if you want to use that cash to buy another investment, you have to sell that first, wait for it to settle, and then use it. So that's just some other consideration too. Some other thing to consider as you're determining where to put your safer money.
All right. Jimbo has a question. If you want to add bonds to your portfolio, what would you add? Midterm, long term, in view of inflation trending down in the long term? Jimbo, I have an unpopular opinion. I don't think that if you force me to prognosticate, I would say that I don't think inflation is going to trend down. And the reason for that is just that I have some uncertainty about the economic policies that I'm starting to see both here in the US and abroad. And it just doesn't seem to me like there is the political will to control inflation in the way that I've seen in the past. Maybe it's just been too long. I mean, the bout of inflation that we got a couple of years ago was really very short compared to what we saw in the 70s and early 80s. And that's just been too long ago. I mean, it's 40, 50 years ago. There aren't as many people around who remember what that was like. There aren't as many people who remember that, you know, it wasn't just a matter of what you were paying for things. It was a matter of, you know, government policy. It was a matter of, you know, I mean, if you wanted to buy a home, you're paying double-digit interest rates. I mean, that just wrought havoc with affordability really across the economy. And so, by contrast, you know, the couple of years that we saw, it seems like a blip by comparison. And so, you know, but what I'm seeing is that, you know, yes, we've made substantial progress in fighting against inflation, but I don't see the same commitment to, you know, the 2% target that the Fed has done. The Fed's getting a lot of pressure from government officials. Nothing new there. The Fed has gotten this kind of pressure before, albeit in different ways. But I think that a lot of people want interest rates to fall so that the economy can, you know, because lower interest rates has typically meant stronger economic growth, but it has also typically meant more inflationary pressure. And so I just think that there's, you know, almost this consensus that, yeah, that 2% target, well, maybe it should be 2.5, maybe it should be 3. We should be happy with 2.5 or 3. If we're happy with 2.5 or 3, then, you know, the next time it happens, then maybe we're happy with 3.5 or 4. And so as a result of that, to answer the question directly, if I am adding bonds, and in fact, I have been buying bonds, what would I add? I have been adding Treasury inflation protected securities, because the implied inflation rate on those Treasury inflation protected securities, when you take the real yield before adding the inflation component, when you compare that to the yield on a conventional Treasury bond that doesn't have inflation protection, it's all baked into the interest rate. When you compare the yields on those two different types of bonds and you kind of do the math, where you end up is like this 2.5% assumption. Now, if I'm wrong and the Fed does eventually get us back down to 2%, then I'm going to be a net loser here. I would have been better off buying a conventional bond with 2% inflation than I would buying an inflation-protected security where the implicit assumption based on current market rates is an inflation rate closer to 2.5%. But if inflation is 3%, 4%, something like that over the period of the bond, then I'm going to be the winner, because I'm going to have done better off than I would have if I bought a traditional non-inflation protected security, whether it is a Treasury bond or a CD from a bank, an insured CD at a bank. You know, the same amount of credit risk involved. It's just the full faith and credit of the U.S. government. But that's kind of because I'm questioning the thesis behind your question of, in view of inflation trending down in the long term, that's kind of where I get with that. I think if I agreed with you and I thought inflation was trending down, then yes, those long-term interest rates would presumably fall. And if they do fall, then you're going to get some price appreciation in addition to the yields that you're getting, which are well above 4% right now.
I'll just add on to that something I've mentioned in the show before. Dan is absolutely right. If interest rates go down, long-term bonds will benefit the most. But generally speaking, if you were just looking at this as a situation, like, I have no opinion on whether rates are going up or down. Historically, long-term bonds have had very poor risk-adjusted returns, very volatile for the additional interest that you get by buying, say, a 20, 30-year Treasury versus what you get on a 10-year. And that's particularly true now, right? The extra yield you get is virtually nothing. So if you were very convinced interest rates are going down, yes, long-term bonds are the place to be. If you don't have a strong opinion, over the long term, short and intermediate term bonds have the best risk-adjusted profiles. And that's what I've also been doing. Short-term, intermediate term, I totally agree with Dan's take on TIPS. TIPS funds don't have quite the same certainty and much more volatile. Dan, if you don't mind me asking, are you talking about individual TIPS or are you buying TIPS ETFs?
I buy individual TIPS. Yeah, I'm getting them through some at auction through Treasury Direct and some just secondary market purchase through my brokerage accounts. But yeah, and I'll second what you're saying with respect to those long-term bonds, it's a trade, and it is something that, you know, you have to deal with a lot of volatility. Turn back the clock to, was it 2022? I think it was, when, you know, both stocks and bonds were down. If you took a ETF like it's the iShares 20+ year Treasury bond ETF, which is ticker TLT, if I'm remembering right.
Yep.
Like that just plunged. I mean, you know, people were sort of like, wait, this is a bond fund. How the heck is it going down like this? And it's because of exactly what Bro said. Those long-term bonds, those prices change a lot. Like, even if the interest rate goes up just like 0.25%, then those bond prices can fall quite a bit on the long-term bonds. And you'll remember, I mean, we got quarter point after quarter point after quarter point after quarter point. I mean, it just went on and on and on. And so, yeah, those long-term bond ETFs, they got hit in ways that, you know, people never seen before. And so, yeah, you got to be really careful and have that conviction and have some risk management in there just in case you're wrong, in order to make sure that that long-term bond bet doesn't sour on you.
Yeah, I looked it up. So, you know, 2022 was a bad year for stocks. S&P 500 down 18%. TLT, the long-term Treasury ETF, down 31%.
And Vihan asking for some clarification on exactly which QSIPs I've been buying. Yeah, it's you know, I'll tell you this, Vihan, the auctions, the Treasury auctions, new tips or reopen tips once a month. And the terms vary. Sometimes it's 10 years, sometimes it's 30 years, sometimes it is 5 year. I don't participate in all of those auctions, but I have participated in some of them. And then, you know, the other thing that I often look for when I'm looking at secondary bonds is sometimes you will pay a lot less and get a much higher yield if you buy like sort of an oddball maturity. So, you know, like everybody loves 10-year bonds, but you may get a better rate if you buy a 9-year bond or an 11-year bond, because the pros aren't paying as much attention to that. And so if I have an ability to, you know, sort of like, you know, selling your car, trading in your car after 3 years, you know, you still get a pretty good trade in. But if you wait beyond that, maybe it doesn't work as well. It's kind of the same thing. If you pick these up when everybody else is trying to sell them, sometimes you get a better deal.
We're almost at the end of the show. I do want to highlight a resource that I often highlight when we're talking about tips or iBonds, and that is tipswatch.com. It's just a site run by a journalist named David Anna in North Carolina, I believe. But he's been investing in tips since the 90s, and he just provides an enormous amount of commentary, but also just instructions on how the tips market works and iBonds. I agree with Dan, by the way, too, that iBonds were very hot for a while, but right now tips are priced probably more attractively. iBonds, I think the real rate on iBonds now is maybe 1.3%, whereas tips you're talking about maybe earning over 2% real being inflation adjusted. So if you're not familiar with the tips market, especially when it comes to buying individual tips, highly recommend tipswatch.com as a resource.